on to all of your questions. Okay, so we're going to start out with kind of an overview of some of the fundamentals, some of the underlying questions that are going on right now in the market. I'm going to take a short pause for from Q&A off of the fundamental issues, and then we'll dive into some of the technicals parts to get a little bit shorter term view of what might be coming in the next few weeks. So just to begin, I want to put things in kind of context for us, because we've had a very rapid run up. We've had a lot of volatility in the grain markets in general, not only soybeans, but also in corn and wheat. I wanted to give some context for why did we see the huge run up, and then why we've seen this retracement, and how we're starting to kind of shift to focus a little bit as we move forward from here. So I want to put this in historical context over the last several months. So first off, what led to this great big run up that we saw this last spring? Obviously, like most things in economics, you can't point to one thing and say this is what caused it, this is what happened. It's actually a culmination or a combination of different things. Now, this is my list, kind of the short list of what I view as the top issues that created some of the volatility you saw coming into spring planting. So first off, obviously, the war between Russia and Ukraine with Russia's invasion on February 24th, that caused a lot of disruption. That we knew the troops were building on the border. I know I said several times in December and January and most of February, my impression at that point was this was more of a political posturing than it would be actually an invasion. Well, obviously I was dramatically wrong. So that did put quite a bit of shock value into it. There's a lot of uncertainty, not only politically, but economically, what that meant. We're still going through some of that. But even on the grain side, because Ukraine was, as well as Russia, major players in the wheat market, Ukraine as well as in the corn market, there was some real concerns and uncertainty about not only production levels, how many acres are going to be able to be planted and harvested, but also then their ability to be able to export, to be able to take that commodity, get it into the global markets. Also tied to that with Russia, Ukraine, because Russia, again, such a large energy producer, second largest crude oil exporter, and one of the largest natural gas exporters of the globe, the energy markets also went ballistic. And as we know that there is this loose connection between what happens in the energy markets and what happens in the grain markets, not only through the ethanol sector and through biofuels like renewable diesel or biodiesel, but also through hedging activities, or at least through speculative activities. So the managed hedge funds, now technically they're not hedgers, but that's kind of the name we use for these outside investment communities that often come in and out of the commodity market. I wanted to explain just a moment that when they come into, as investors, when they come in and start buying or selling commodities, they typically buy and sell a portfolio of commodities. And when we talk about commodities in the world of trading, especially financial trading, that's really a bundle of not only energy stocks like crude oil and natural gas and RBOB, which is refined fuel, but also the meat products, precious metals, what we call the softs, as well as the grains. So the grain complex, corn, soybeans, wheat, tend to be a portion of a much larger portfolio. So even though there's a fundamental supply-demand connection between energy prices and what happens in the grain markets, there's also this outside investment community that's adding this connection or strengthening those price relationships. And they tend to shift over time. I'm not saying that there's a one-to-one where you can pull a lever and it'll be an exact response to it, but there are periods of time when these outside investment community really come in and start playing a significant role in pricing and price movements. So with the uncertainty from the war, with the increase in energy prices, that also added fuel to the fire when it comes to the fundamentals in the grain markets, that added to some of the volatility we saw in the futures markets. Value of the US dollar was also rising quickly, mainly because when we look at the value of the US dollar, it's how does the US economy compare relative to some of the other economies in the world? If you have investments, where do you want those investments to be located? what kind of denomination, what kind of units do you want to have those in? The US dollar is kind of considered the safe haven. So when there gets to be a lot of uncertainty in global markets, especially global financial markets, the dollar tends to rise. So either the value of this dollar rises faster than other commodities or other currencies, or if prices are falling, let's say the values, if we have some kind of recession, a rising dollar, what that means is, yes, the value of the US dollar might be dropping, but it's not dropping as quickly as the euro or the Japanese yen, or other currencies. So because of this uncertainty, kind of this what they call flight to quality, the US dollar was rising quickly. And that of course was kind of a negative tone, really, because typically when we have higher dollar values, that makes it harder for us in the United States to sell our products internationally to be competitive. You know, we were in the heart, this April-May time period, we were in the heart of the bad weather, and everybody was really, really concerned about how many acres were going to get seeded. What was our prevent plant going to be? Does this really have an impact on the distribution of acres that we're going to plant? Corn versus soybeans versus wheat. A lot of uncertainty, and anytime you have uncertainty, there's going to be this risk premium that's built into the marketplace. And finally, at about that time also, there was some increasing concerns about the size of the Brazilian safrinha corn crop. So the safrinha crop is the second crop corn. In a large portion, think of it this way, a large portion of Brazil, they can do double cropping. They're close enough to the equator. The safrinha crop is really the larger of the two crops of corn they grow in Brazil. It tends to be in the northern part of Brazil. Well, for example, in Mato Grosso, where they'll harvest their soybeans, they'll come back and plant corn. And many years ago they would do soybeans on soybeans, but because of rotation restrictions now, or rotation problems, they're doing more of a corn soybean rotation. The point being that approximately 70% of the total production of corn coming out of Brazil is in that safrinha crop, that second crop corn. Some of that does hit the international export market. So obviously the size of that crop has an influence on the ability of Brazil to be able to export corn and compete with corn and US corn in the global market. The point was, at that time, there was also a risk now of hot, dry weather starting to occur in that safrinha crop. So we had a lot of not only fundamental reasons, but also investment or technical reasons why prices would go up. So let's fast forward to today. What's happened? Well, we still have the impact of the Russian-Ukraine war. This is still an evolving issue. There's still some major concerns about grain production as well as grain exports, even though there now has been an agreement between the Ukraine, Russia, Turkey, and the United Nations to try and come up with a plan to allow more grain to be exported out of, in particular, Ukraine. We'll still have to wait to see a little bit how well they can operationalize that plan. I personally have some concerns about how much grain is actually going to be able to move long-term in particular. We'll have to wait to see. But so there's still some uncertainty there, but it looks like, at least right now, the attitude in the marketplace is, well, we might be seeing some relief. There might be some ability, increased ability for Ukraine in particular to be able to add some both wheat and corn into the global markets. Crude oil has fallen. So we've fallen from about $117 to that $94, $95 range per barrel. As a result, we've seen some of these hedge funds exiting the commodity market, primarily driven by crude oil, but also by the grain complex. So we're starting to see these net positions going from a net long to more of a neutral position in the outside investment community. The value of the dollar seems to be stabilizing. We kind of had a rally with a spike. We started to stabilize at about 106, which is actually an index. So it's like a ratio. 106 is relatively high, but it's not as high as the peak was. Right now, and I'm going to shift gears a little bit, and I'll talk about more of this in a moment, trying to set Mark up for some of his deeper discussion into weather. For the next several weeks, the Corn Belt weather is going to be watched closely. So up until recently, a lot of the news that's been impacting soybean, corn, and wheat prices has really been either primarily outside of agriculture. It's been these bigger macro economic as well as geopolitical issues that have been kind of throwing a lot of uncertainty and concerns into the marketplace. In my opinion, as we move into the next several weeks, because of the key reproductive stages the corn and soybeans are going to be entering into, we're going to go back to more of a traditional weather market, at least for a while here, until we start figuring out kind of yield and yield potential we're coming out of the major corn and soybean producing areas. I'm going to talk about that in more detail in a moment. The other thing, just as an update, the Brazilian safrinha crop was not as bad as everybody had expected. There was some cooling and some rain showers that we hit later on in the season. It's not a monster crop by any means, but it's not a bad crop either. So we did take some of the top end off of a yield potential off of that safrinha crop, but it was still not a bad crop. So Brazil will have a considerable amount of corn to be able to export. And as we all know, there's this linkage between the corn and the soybean market that we need to follow as well. So diving a little bit deeper into kind of the supply demand conditions, I always like to try and talk a little bit about what USDA's their forecasts are. The column on the far right-hand side, which is 2002, 2003, those are our July estimates. So this is the information that USDA, their forecasting models came out and was released in July. These are monthly updates, so we'll get another update in August. I'll talk about just a moment about that. So the first big issue is kind of the numbers on top. So let me finish. The column on the far right hand side in blue is the current year. It's the crop that's growing in the fields today. The green is last year's, it's old crop. We technically have not finished our old crop marketing year. That will happen at the end of August. So we're getting very close. So the column in green, those numbers there's a little bit of forecasting left. Most of those numbers are pretty well known. I think we'll see some minor refinements as we go into the close of this marketing year. The focus is really primarily on those blue numbers on the far right-hand side. We spent some time talking about and worrying about how many acres were actually seeded. In the July report, USDA did update or they decided they were going to resurvey some of the planted acreage for North Dakota, South Dakota, and Minnesota because of the late plantings. I really don't expect any of those numbers to change very much. The focus right now is really on yields and yield potential. The number that's currently being used for soybeans at 51.5 bushel national average yield is really a trend line yield. So really what USDA has done is saying we're going to take the average yield we've seen historically, we're going to adjust for improvements in production because of technology, not only genetics, but also better seeding and harvesting technology. The science of agriculture gets better every year. And so in general, we have this upward trend in yields. So think of that as kind of the average yield that's been adjusted for our current technology. So in August, and this is one of those dates you want to circle on your calendar, August 12th, the WASDE report, this World Agricultural Supply Demand Estimates, as well as the production report will be updated. And what's significant about the August report is that's really the first month that USDA will update their projections and come in with formal projections or forecasts for both corn yields and soybean yields. Now, in the August report, what they're going to do is they're going to survey about 18,000 farmers and say, look, given what you see today, what do you expect your average soybean yield to be on your farm? Okay, they're going to combine that information with what's called remote sensing. Now, remote sensing is just code word for we're going to use satellite imagery to try and enhance our ability to project yield. In the September forecasts, in September, USDA will add a third source of data, or third source of information to try and refine this yield forecast because everybody is so sensitive to that particular number. In the September report, USDA will resurvey their farmers. They're going to update all of the remote sensing, the satellite imaging, the forecasting that they've done that way. They're also going to add the information from field observations. They'll send USDA contractors out that will actually survey fields and try and estimate yields just like a crop insurance adjuster would do. So they're going to go out and measure what the planted, how many plants per square foot there are. They're going to count pods. They're going to try and make estimates of yield based off of actual field observations. So in August, we have 2 sources of information on yield and yield projection. By the time we get to September, there's going to be 3 sources, and those 3 sources are then blended together to get this number. The information will be released. They'll have a national average number, which is going to be weighted by area, but they'll also put statewide yield numbers. And I know a lot of folks, especially market analysts, will not only look at the national number, is it going to go up or down from this 51.5, but also look at the state numbers, because in a few moments, I'm going to talk a little bit more about soil moisture conditions and what areas of the corn belt in particular that we have to be concerned about. We talk a lot about, at this stage of the game, we're talking a lot about production and production potential. I do want to also kind of give a hint for the consumption side. So what do we see on the usage side of the ledger? The blue line on top is crushing. The dotted line on the far right-hand side is the current USDA forecast for the crop that will be harvested this fall. Okay, so the blue line is crushing, the red line is exports. So let me separate those two a little bit. On the crushing side, there's been very strong crush demand the last several years. A lot of that has been driven by the increase in interest in renewable diesel and the profit margins that are available there. I know we've had many reports of growth and expansion of crush facilities, especially here in the Northern Plains. That's obviously going to have an impact on the flow of grain within our particular region. But when you look at a national level, the growth rate of the crush industry right now is really capped by our ability to add new plants, or at least expand the plants that are also there. So that takes a lot of capital expenditure. It takes some time to do that. So really the growth rate right now is a function of how quickly can we add capacity to the industry. So even though it's a forecasted number, again, I personally don't have a big argument with the number that USDA is currently using. On the export sides, that becomes a lot harder, more difficult, more tricky to try and forecast or project. If you notice, we do have a slight downward trend in our forecast for exports. Now, there's a couple of reasons for that. Part of it, again, the big drop that we saw 2018, 2019, that was because of the trade war between the United States and China. There was some catch-up buying in 2019, 2020, that marketing year. That's why you see that spike that came up right after the trade war. China in particular was rebuilding some of their inventories or using some of the U.S. production to do that. But since then, we've seen kind of a stabilization or even a slight drop off. And there's a couple of reasons for that I'll talk about in just a second. Just as a reminder to everybody, the 2 biggest exporters of whole soy. So this would be whole soybeans, not processed product. Brazil, number 1, which is the blue line, and then the United States, number 2, which is the green line. The 3rd largest is usually Argentina. And again, that's relatively small compared to the United States and Brazil. The real reason for that, of course, is because Argentina tends to process a lot of their product and sell it as oil and meal as separate products rather than selling the whole soybean. When we look at, again, growth or change in exports and forecasted export levels, Brazil, the forecast right now is for it to rebound and increase, mainly because we're looking at additional planted acres. You put a trend line yield onto the Brazilian crop. They have more capacity to be able to export. The expectation right now is that a lot of those beans will hit the international market because their crushing industry is not quite as large as it is in the United States. So the moral of the story is the 2 big exporters, the global soybean market is actually relatively straightforward. You have these 2 big exporters and you've got 1 major importer, primarily being China. Notice that we did see, obviously we saw a drop off during the trade war. We saw recovery. We saw kind of an echo to that with now a projected recovery. That shifting or kind of some of the volatility of Chinese imports, some of that, actually I'm going to argue a significant portion of that has to do with the rebuilding of the hog herd, the hog industry in China, post-African swine fever. So if everybody remembers, about the time we had the trade war, China also had this major outbreak of African swine fever, which made a significant reduction in both their breeding herd as well as their commercial hog herd. Well, they have been able to rebuild some of that. They're in the process of rebuilding that, but they have, for phytosanitary reasons, to try and control African swine fever. They've also been adjusting their inventory. They're trying to move away from some of these backyard hog producers, the smaller operators, and go to more of a confinement hog operation, because the confinement system makes it a lot easier to provide a buffer or control African swine fever, especially as it shows up in the wild hog herd. The moral of the story is they are in the process of rebuilding. They're still seeing this shift in the production systems in China. But add on top of that, now we have COVID. And because of the rules that China has for controlling COVID, essentially they lock down cities, they lock down the areas that have the problem to try and contain it. That has really had also a major disruption in their economy. Again, they're very export-based. You start shutting down a city like Shanghai, which is larger than New York City. You shut that down for a couple months, and it has a significant impact on the economy. So the economic growth of China is closely linked to the amount of meat and meat consumption, pork being the largest meat product in China. Poultry and beef are relatively small compared to pork. So there's this what I'm saying is there's a connection between economic growth in China, the demand for meat, and then their ability to produce that meat. And so these combination of things, it looks as though the expansion, this long, almost 30-year expansion we've seen in the Chinese hog herd, and resulting import demand for soybeans is starting to flatten. It's starting to get a little bit more volatile. So the real question then is coming back to our ability to supply the Chinese market and our ability to compete with the Brazilians. And again, as we look forward with the anticipation that we're going to have increased soybean acres in Brazil, again, you put a trend line yield onto that, which is what we usually use for forecasting. And it looks like globally, we are going to have some competition in the soybean market internationally. So again, this is a developing story. It's something we'll keep an eye on as we move forward. When we look at carryover stocks, and again, I want you to focus primarily on the blue bars on the bottom. So just to refresh everybody's memory, the green line on top, the bounces around is total U.S. production. The red line is total usage of U.S. soybeans. That includes both domestic use and international exports. The blue lines on bottom is that stocks to use ratio. It's scaled on the far right-hand side. What we're doing is we're taking our ending stocks divided by total use. So think about it as, what is our margin for error? How much do we have kind of in reserve or as a buffer in case there's a problem as we move forward, whether there's a U.S. production problem or a Brazilian production problem, or there's sudden a big shift or increase in demand base. The moral of the story is what we tend to see is when those blue bars are small or very low, where our margin for error is very thin, we tend to have higher average prices with a lot of volatility, because any new piece of information, any change in expectations has this shock value, has this big, the pricing system has to work very hard to try and ration use and or stimulate demand. Now, if we get into an environment where we have lots of carryover stocks, the bins are full, or that blue bar is really large, that means that we have this buffer, we have the shock absorber. So new information as it enters the market doesn't have that shock value. So we tend to have lower average prices with less volatility. It's not that prices don't bounce around, it's just they don't bounce around as much. So let's really quickly look at the red bar on the far right-hand side. That's the current USDA forecast for new crop soybeans. If you look back historically, and I personally, I'd probably throw out kind of what happened in 2018-19 with that great big spike, because that was the peak of the trade war years. If you look kind of and say, well, what is our, for the last, 10 or 15 years, what has been our typical number that we see? It's been right around that 5 to 7 or almost 8% carryover stocks. So we're not dramatically low right now, but we are in the low end of normal. Okay, so that's kind of the way I would explain it. We're not at the record low that we saw in 2013, 14, but we're not necessarily flush with grain. So if USDA forecasts are correct, we're going to have kind of a little bit on the tight side when it comes to supply and demand. So I'm going to flip one more slide, and I want to show, we're going to pick out a couple of years, for example, that 2013, 14 timeframe. We're going to look at that 18, 19 relative to where we are today. So this is a long-term, what we call a continuation chart. It's for nearby futures. So that's the futures contract month that's closest to today's date. I know there's a lot of stuff going on here. If you just look on the far right-hand side, I pulled these charts late last night. So if you look at the blue number at 1441, that was the futures market price for the most active market, which was right now the November contract. So November soybeans was at 1441. That's the blue one, right? That's the blue square on the far right-hand side. If we start looking back historically, this is kind of again a very long-term chart. We do see, again, during our trade war years where we had that 18-19 time period, and if I can get my little cursor to work down in this region, again, very high carryover stocks. We tend to have relatively low prices with very stable prices in a relative sense. Now that we've started to bring our inventories down, again, this shock value is coming back. So average prices are increasing. Our margin for error is much tighter. We're starting to see a lot more volatility. The volatility we're seeing today over the last couple of years is very reminiscent of what we saw back here in 2012, 2013, and even into 2014. So I took these blue, the red lines. I tried to put in some very simple support and resistance levels. When we look at today's prices relative to long-term history, now again, I want to caution everybody, this has not been adjusted for inflation. So when we look back here in, for example, this 2003 timeframe, that is in 2003 dollars. It's not in 2022 dollars. But it does give you again at least a reference point. We are right now kind of in the middle of the range price-wise for what I would look at as kind of these longer term price ranges. And again, I'm looking at a very long-term framework. We're looking at a shorter time framework in just a moment. So where are we today? Yes, they're very good prices, not nearly what we saw obviously this last spring, but I tried to explain why we saw that great big rally earlier this summer and what some of the changes are that we've seen so far today. I want to touch just a little bit on corn and wheat because there are competing crops. There's obviously a linkage between corn and soybeans, in particular for feed. We're starting to get a little bit stronger linkage on the energy sector as well. But I do want to touch a bit on corn because there is this linkage. We have to understand that because it goes into the market psychology in soybeans. So again, supply demand table for corn. A couple numbers that I want to focus on. Again, we did get an update on planted acreage in the July report. We will be USDA is resurveying planted acreage in North Dakota, South Dakota, Minnesota. We'll get that information in August, in this August 12th report. I really don't expect, again, any major shifts. We'll probably get some refinements. The big number that the market's going to be watching, as I said earlier, is really the corn number. Is the corn number. Right now, the trend line is at about 177. The real question, again, is that going to go up or down from here? And the hotly debated topic right now, and we'll get some of the professional industry forecasts coming out just before the USDA releases theirs. So again, I want you to circle August 12th. That is going to be a very volatile day just because we're going to get new information in the marketplace, and both domestic and international buyers are going to trade off of that number. Whether you agree with it or not, that's kind of irrelevant. That's the number that people are going to be trading off of. On the corn side, again, utilization, the usage part, the blue line on top is for feed and residual. Technically, it's feed and residual. The vast majority of that is the feed industry for livestock. The red line is for ethanol. The black line is exports and the green line is everything else. Once again, those little dots on the far right hand side represent the current USDA forecast, so they can go up or down or be adjusted. I guess the general trend for feed has been relatively stable. I do think, in my opinion, the reason we're seeing a little bit of a dip or downturn in the feed and residual numbers is primarily because of residual, which is really also considered spoilage and wastage. When we tend to have a very large crop, we tend to have a little bit higher spoilage and wastage numbers. So I would consider the feed demand to be relatively stable, has been for the last several years. We have seen a recovery in the ethanol demand because of the drop we saw was primarily because of COVID. People stayed at home. They didn't drive as much. Now that we've reopened our economy, people are traveling more. Yes, gasoline prices are very high right now, but to be very honest, there's more of a correlation between the amount of corn going into the ethanol industry and miles driven, how many miles, how many gallons are we consuming, than there's about price. So whether prices are high or prices are low, the correlation between the ethanol industry, their to some degree their profitability, but more importantly their consumption, how much ethanol they need to produce, is more closely tied to the miles driven than it is necessarily the price of gasoline. So the kind of the concern right now, kind of the worry in the back of people's mind in ethanol is, well, with these very high gasoline prices, are we going to start to see a cutback or drop in demand, or are we going to cut back or change our driving habits, which might then have an impact on the amount of ethanol we need to produce, therefore the amount of corn we need in the ethanol sector. I'll share my personal opinion. I do think, again, the USDA has it relatively close. I don't have a big problem with the number they're using right now. It doesn't seem like, even though there are some adjustments in driving habits, it doesn't seem like we've been making any substantial adjustments or reductions in miles driven. So I do think the demand number for ethanol is about right. Exports is always one of those really difficult things to forecast. Once again, we've seen a kind of a leveling off of the demand for exports. This is the area where on corn, I think we might have a little bit more volatility. We'll have to wait to see exactly how this plays out. And part of it has to do, again, with what's going on in Ukraine. So I just wanted to show historically a very quick snapshot. The green line on top is the amount of corn exports from the United States. The blue line is exports out of Brazil. The black line, exports out of Argentina. And then the gold line is exports out of Ukraine. Again, these are USDA numbers, so we're going to use that as a common reference point. There is this expectation that not only corn production, but also the ability of Ukraine to export corn is going to be very limited moving into the next calendar year, at least into this 2022-23 marketing year. Now, with that drop off, obviously, we've seen an increase in global corn prices. We've seen readjustments going on and who's buying corn from whom. In my opinion, I don't think we've really seen all those adjustments quite yet. There's been more of an adjustment period in wheat because the wheat market was more directly impacted. But I think the corn market's still trying to figure out exactly how this is going to play out and about how many bushels can Ukraine actually export. So those are the four largest exporters, at least historically, for corn in the global marketplace. So again, this is one of those spillover effects from the Ukraine-Russia war that we need to be watching pretty closely. When we look at inventory levels, again, if you look back historically at the stocks to use ratio for corn, again, focusing on that, the red line of the current USDA forecast, about a 10% carryover stocks. And once again, when you look across historically, I would consider that to be kind of average. We're kind of in the middle of the range. We're not on the low side. We're not on the high side. I want to take us back a little bit into what I said about soybeans. Soybeans, we're within the range, but we're kind of the low end of the range. So my point is, as we move forward, especially we get into these key reproductive stages for the corn and soybean crop, in my opinion, I do think the soybean market will be the leader. I think corn will be more of a follower, just because we do have a little bit more carryover stocks and a little bit more buffer, at least domestically, to be able to handle some kind of production dip. On the soybean side, our margin for error is still relatively small. And so the pricing system is going to have to work a lot harder to start rationing use if we do have a problem in the domestic production. So I look for, rephrasing that, I look for soybeans to be a bit more volatile price-wise than corn, just because of these inventory levels. But then also if we start to get a major rally, my suspicion is, my opinion is that we'll start to see soybean as that leader in the market, and corn will be a little bit more of a follower. When we look at corn prices, again, these are charts that I pulled last night. 616 for December corn. Obviously, that's not a bad price. Everybody would like to have the $8 back. I understand that. But I think it's going to take something really, really unusual or very substantial to get us back into those $8 levels. So I would look at, I know this is quite a range, but I'd still look at that from a longer term standpoint, kind of that 525 to the 680 range as being kind of a longer term, given today's levels, kind of a longer term boundary. So I'll talk more detail again in the technical analysis portion of what we might look for in the next several weeks. So just to give you a longer term perspective. Just a couple comments on wheat. Again, I don't want to go into this. There's a lot of things going on in the wheat market right now. One of the news issues that I think most of you may have heard from yesterday, the wheat quality tour has now concluded here in North Dakota. They did an estimate. They drove around the state of, or the region actually, mainly North Dakota, but they did get into South Dakota and Minnesota a little bit. The average that the tour came up with, where they have people go out and sample fields, was about 49.9 bushels per acre, almost 50 bushel per acre average, which is about 10 bushels an acre above kind of the 5-year average. Now, the 5-year average can be skewed a little bit because of what happened last year due to our drought, but this basically, I'm going to call it round up and call it a 50 bushel average wheat yield is pretty phenomenal. It really is. I had a chance to drive across North Dakota the last few days, and boy, most of the crops look very, very good, although they're late. And I think that's one of the things we're going to be talking about later, especially in the Q&A section. So even on the wheat side, we're anywhere from 2 to 3 weeks behind in development. I think the same thing can be said for corn and soybeans. The crop looks really good right now, but we need to have a really nice September from a weather standpoint to try and finish this crop off. So on the wheat side, again, just a little bit more on the fundamentals. Our production for both spring wheat and winter wheat this year we're going to see a recovery, mainly in the spring wheat and Durham areas, because our crops are looking a little better, obviously better than they did this time last year. Our usage levels, our consumption levels, again, the food use, primarily domestic milling, is relatively stable, which is the blue line. The red line is exports, again, more difficult to try and forecast and project. And then we have feed and seed being relatively small. Just want to make one or two comments about the export levels. We saw a dramatic drop in export levels from 2020 into 21. A large portion of that was driven by just a smaller spring wheat crop, but also driven behind that is kind of the relative competitiveness of U.S. wheat in the global markets. And that is one of the things I guess longer term a little bit concerned about, that we need to keep an eye on. USDA is currently forecasting the same level of exports as they did last year. And I guess of all the numbers that USDA is forecasting, this is the one that I'm kind of questioning a bit, in particular, given some concerns about the supplies coming out of the Black Sea region. Again, if people have more questions about that, we can certainly talk about it. Again, just to put things in relative sense, the red line on top is Russian wheat exports. Again, I tried to highlight Russia, which is in red, United States, which is in black, and Ukraine, which is in blue. These are wheat exports. Notice again, dramatic drop off in the expectations for Ukrainian wheat to hit the global market. Russia's having a really good year. Their total production for wheat is expected to be up pretty significantly. Again, if they can get those bushels sold and exported, will be the trick or the concern. And then we have the United States being relatively flat compared to last year. On an inventory level, now these numbers are going to be heavily dominated by winter wheat stocks. just because of when the surveys are taken. Again, we're not necessarily short of wheat in the United States. We're a little tight on the spring wheat side, but when we look at total wheat supplies in the U.S., we're actually pretty comfortable. We're finally bringing some of those extra reserves down. Wheat volatility is going to continue to be an interesting thing to watch. I guess with the news that we had from the North Dakota crop, that's starting to take, I think, some of the uneasiness, some of the concern out of the wheat market, some of that risk premium. There's still some issues going on with the spring wheat crop in Canada that we need to keep our eyes on, because there's some drought areas that are persistent in Saskatchewan. Tremendous volatility in wheat prices. We haven't seen this kind of volatility in a long time. We'll wait to see kind of what the upside potential is for wheat. But again, that's a little bit different story, and I don't want to take a lot of time today to focus on that. So let's zero in a little bit. I'm trying to set Mark Ewens up for some of his comments as well. But these are the things the market traders and analysts are also talking about. Now, this is a Drought Monitor Map. It was updated yesterday. You can see the areas of, in particular for soybeans as well as for corn, the areas we have our eyes on is obviously Nebraska, and recognizing also that a pretty significant portion of the Nebraska farmland is irrigated, at least the cropland is irrigated. So even though there's some drought conditions here, that we may not see the yield drop off in Nebraska that we would, let's say, in a dryland area like in North Dakota. The other areas we're keeping an eye on, of course, is southern Minnesota, kind of what's happening there, what's going to happen for rain showers and the ability to recharge some of that soil moisture. Northwest Iowa has been a bit problematic since last fall. There's also this area kind of in eastern Illinois and western Indiana that's also becoming an issue. Just on a sidebar comment, Missouri does produce a significant amount of corn and soybeans, but the majority of the corn and soybeans, I went to school in Missouri for my PhD, so I got a chance to learn a little bit about their agriculture. The majority of the corn and soybean area in Missouri is in the northern half. So even though Missouri, the southern part of Missouri, looks very, very dry, obviously they've got drought conditions going on, there aren't a lot of corn and soybean acres down in this area. There are along the Mississippi River, what's called the Boot Heel. There's quite a bit down there. But when we get into the central and south western Missouri, there really isn't a lot of cropland. So the majority of the production is going to come in northern Missouri. One of the things that USDA does is they take that Drought Monitor Map and they overlay, or they impose on top of a map of where is the corn and soybean being produced. So let me go back one step. Anything that has a D0, that anything in yellow or more, is going to be reflected in this hatched area. So this red hatched area represents some level of drought or drought intensity. And then what they've done is they say, well, what percentage, approximately what percentage of the bushels or total production, the bushels we produce in the United States, are being impacted by drought? So in corn, there's about 29% of the corn area, not area, land area, but the actual production. So if you're darker green means that it's a very core producing area, the lighter green means there's corn, but it's not a substantial corn producing region. So we start overlaying all of this stuff. We're looking at about 29% of the bushels, potential bushels in the US, have some kind of drought or drought intensity. Again, I want to emphasize, in particular for corn, because a vast majority of the corn in Nebraska is irrigated, as long as the irrigators can keep up, as long as they can pump enough water, any kind of yield reduction can be mitigated. It can be reduced. So I do think we're going to see lower yields coming out of Nebraska, but probably not as large a drop off as you would expect. Moving to soybeans, again, the drought monitor hasn't changed, but the production areas has. Notice that in soybean, we have a lot heavier concentration in this Mississippi River Valley, but that's also where we're starting to see more of the soybean area. So about 26% of the soybean bushels, at least potential bushels we can produce, is under some level of drought. So yes, we always have some drought in the United States. We always have some impact. Is this a substantial impact? Is this something that's going to have a major influence? Maybe yes, maybe no. So we're gonna lean on Mark pretty heavily here in a few minutes to try and give us a little more insights. Spring wheat, again, just to touch on it, the North Dakota wheat area is actually in pretty good shape this year relative to last year in particular. There is a pocket up here in kind of the Golden Triangle region of Montana that we have to watch, but only about 16% of the bushels for spring wheat is under some kind of drought or drought conditions. I wanted to pull up a couple more maps. Again, the Drought Monitor Map looks at the soil, the moisture in the soil profile, the entire soil profile. So it goes very, very deep into the soil profile. By the time you get those heavy reds and ambers, we're looking at dry soil conditions that are very deep in the soil profile. So we're having wells that are starting to go dry, stock ponds are going dry. Now, for crop and crop production, we're really more concerned about the root zone, kind of that top meter, about the top 3 feet of soil. So this is a map that's been generated. It's a computer-generated map, but it's a map that's been generated with a joint venture between the USDA and NASA. So NASA has been doing satellite imagery for many, many years. They've been working together to try and refine some of their ability to not only model, but also forecast or project different, not only weather conditions, but also crop growing conditions. So this is a map that I pulled up. This is as of July 26th. If you notice on the very bottom right-hand side, what they're trying to do here is estimate the soil moisture relative to normal. And I'm going to put air quotes on normal. If you notice on the left-hand side, bottom left-hand corner, the normal is the average since 2015. So they don't have a really long data set to pull up as an average, but given the modeling they've done, and yes, they have ground truth this, they've tried to actually in their models to try and cross-check and validate the numbers. But if we're looking at from 2015 through 2021, we're saying that's the average time period. How do we compare today relative to this average? What are the soil moisture conditions right now relative to average? And really, again, focusing on that top meter or the top 3 feet of soil. So the reason I'm bringing this up is and I'll show you in a moment, there is the extended forecast is for hot and dry weather coming up for the next couple of weeks. And so the issue then, as we get into these key reproductive stages for soybeans and for corn, will there be enough soil moisture to be able to carry that crop through that key development stage and maintain yield and yield potential? So I'm trying to get at, where are the areas we need to watch and be concerned about for yield and yield potential. Obviously, Iowa, Illinois, southern Minnesota are the areas, the core areas we're going to be focusing on, because those are the big bushel producing states. As we saw in the Drought Monitor Map, Nebraska has some issues, even within the top meter of soil. There are some issues going on there. I think a lot of focus is going to be, again, on the southern Minnesota, this area in southern Minnesota and Wisconsin, kind of the two corners of Iowa, northwest and southeast, and then this pocket or area we have in eastern Illinois and western Indiana. Those I think are going to be the areas people are most concerned about, and we're going to be watching very, very closely. So looking at things a little bit more from a crop production standpoint rather than just soil hydrology. This is from the same data sets, the same project. This is vegetative index. So if you remember, we have this NDVI, which is just to measure a satellite measurement, a photographic estimate of how green is the crop. What's the reflectivity of the crop and crop areas? And again, this is the change from, or it's the deviation from. Again, USDA and NASA have been doing this much longer. The satellite imagery and the modeling aspects for NDVI are a little simpler than they are for soil moisture. So we have average information from about 2000 through 2021. So if we look at that approximately 20-year average, we say for this week, for this time period, if you notice on the bottom, it's from July 18th through the July 24th. We take that time period and say, well, what's the greenness of the crop today relative to what we have seen at this time of year in the past? And on the scaling is on the far right-hand side. So this beige areas, in particular, for example, in Iowa, southern and central Minnesota, Illinois, Indiana, those areas right now look about average. So from a from a crop health standpoint, just from how does the crop look, we're looking at about an average crop right now. And if you notice up in North Dakota here, especially in Western North Dakota, they've been getting a few more rains than they would normally see. So again, crop health, crop condition looks a little above average, which is in the green. Then we get down to this Texas, Oklahoma area. We start getting into the deeper browns. So the crop health is at a much lower level than we would normally see at this time of year. My point in doing this is even though there's some dry areas starting to show up, when we look at soil moisture, when we look at it, and looking forward now as we look into the weather forecast for precip and temperatures, right now it's really not showing up on the crop. So the crop looks really good, in particular in the traditional corn belt. We're not seeing anything, at least from the visual standpoint. We're going to be monitoring this very, very closely as we go forward. And this is really the next couple slides is what the markets right now are very concerned about. We're starting to see some recovery and rally back into the corn and soybean markets. This is the 6 to 10 day forecast. This is out of National Weather Service. There's a high probability or high odds that we're going to have above average temperatures for this time period, August 3rd through August 7th into the middle of the Corn Belt. So from a temperature standpoint, we're looking at above very high odds of above average temperatures. A little bit below there's a probability that we're going to have a stronger probability when a below average rainfall. And of course, hot temperatures with below average rainfall, we got to rely on that soil moisture to be able to get the crop through that pollination phase, pollination and flowering both. So the markets are looking at this. They're starting to get real concerned. I do think we're starting to put some premium back into both corn and soybeans. I think that premium will continue to grow as long as we have these forecasts for hotter and drier conditions. When we look at the 8 to 14, a little bit further in 8 to 14 day forecast, actually we got a very similar story. Now probably again, the window for forecasting gets to be a little fuzzier as we move further into the future. But again, the trend is the same. When we look at precipitation, there might be some spotty showers. Again, I'll wait for Mark's forecast here, but there is some, from what I have seen, some call for some spotty showers as we move into that corn belt area for the 8 to 14 day. Obviously, this changes day to day, but the market's going to be watching this again exceptionally close. So I'm going to go through a couple more slides, and I'm going to take a pause for questions. We're trying to get things answered. I'm going to use this as the transition from the fundamentals into the technicals, and from a technical standpoint, using what we call the static numbers instead of using stochastics, which is like moving averages. When we look at things statically, I put in some support and resistance lines. This is for November soybeans. Again, this chart was taken last night. I'll show you some real-time information in just a moment. But in my opinion, we've started to break through some of these resistance levels as of last night. So this is now starting to open up this window for soybean prices, especially for November beans, to start moving forward. So we had again this big rally coming into the spring planting. We've seen the drop off as things started to stabilize. We're starting now to put some more risk premium back into it. My opinion, the largest portion of that risk premium is from the weather and weather forecasts and concerns about yield and yield potential. So how far will this run? Great question. Obviously, I don't know the exact answer, but from a technical standpoint, the static technical analysis, getting in just above $15, and I think psychologically the $15 mark is probably a more realistic number. But we've got some room to run here in the soybean market. Where that ends up, I would be looking at kind of $15 as that first key trigger point. That by the time we get to $15 in the future, there gets to be some psychological resistance to moving higher. So the question is going to be, is this hot, dry weather, is the concerns about flowering and pod set going to last long enough to give us enough lift in the market to be able to do that? And again, because we have smaller stocks, it doesn't take quite as much lift to be able to push us higher in the marketplace. Looking at corn, we're seeing some similar trends in corn, but because of the stronger carryover stocks, we got a little bit more in reserve. It's going to take a bit more of an updraft. It's going to take a bit more upward a risk premium to be able to push us through some of these key pricing points. I think 630 historically is looking at one of the first places we have to be concerned about. If we can break through the 630 mark, then it's looking at about I would call it probably 655. I'd be a little bit on the conservative side. I don't consider these to be really hard, strong barriers. They're not going to be tough to break through, but we are going to have some support, some additional, again, risk premium put into it, some concern about weather and weather problems to make that happen. Just a real comment on spring wheat. Spring wheat, because of some of the issues going on right now in the wheat market, I think we can still break through this 950 mark, but it's going to take some additional work. In particular, now that we've had some of the information come out about the crop tour, and the North Dakota crop is looking a little better than I think people first expected. So with that, I'm going to take a short pause. I'm going to stop sharing my screen and see if there are any questions from the group that either come in or that you want to talk about right now.
So just a reminder, if you do have questions, put them in the chat. I'm watching that right now. I'll repeat them for Frayne. If it's a very long and complicated question, we can have you come off mute as well if you'd prefer. But as of now, Frayne, I don't see any questions in the chat.
Okay, very good. So I'm going to try very hard to stay on time to give all of our other presenters a chance to go through this.
Sure.
So I will share my screen again. I'm just going to there we go. So I'm going to shift over into some of the technical analysis. Now, from a technical analyst standpoint, we're really looking at price trends, price movements. We're using the activity in the futures market to get a better idea and a better sense for what are some of the pricing points. I like to use the term psychology in the marketplace. What is the momentum in the marketplace? We're going to be focusing on 3 key stochastic indicators. The stochastics just mean we're watching price movements. The stuff I showed you before was really more of a static analysis. We're now looking at kind of price movements, price trends, as well as price momentum. I'm going to focus first on the November soybean futures. I'm going to try and make a few comments about December corn, because again, those 2 crops do tend to have some connection, not only from a fundamental standpoint, but also from a trading standpoint. So the first comment I want to make, this is DTN ProfitX. This is one of the software programs we use pretty heavily within the commodity trading room. We use this. I use it for educational programs. I know Bill uses it a lot in his classwork working with undergraduate and graduate students. This area right up here in the kind of the top center portion is the current futures for soybeans. The little gray things that you see popping and blinking at you is actual trading that's going on. So this is live trade. There's no time delay. Just a real quick comment. A couple things that you need to keep in mind. So these August, September futures, those are still pricing for old crop. Now, I know there isn't a lot of old crop soybeans left. A lot of the focus right now is on new crop and new crop pricing. But the new crop really starts obviously in the November futures. I do want to show just really quickly, we do have a carry, at least in the futures market. There's a carry or an incentive to a partial incentive to store grain. So if we're looking at delivery in November relative to delivery in January, we've got about a 6-cent carry in the marketplace. But then by the time we get into March, we start getting into an inverse again, where we start looking at prices actually going down. So what that's really signaling, and I know both Bill and Dave are going to try and reinforce this as we move forward, that we really have a relatively tight window where the U.S. soybeans are competitive in the global markets. And I just wanted this is a really kind of a classic way of showing that right now, given everybody's expectations, given the information we have in the marketplace, the market is really signaling, yes, we want delivery of soybeans in November. we'll extend that demand base and the incentive to be able to store and deliver into that January, February time period. But by the time we switch to that March futures contract, that incentive starts to get less. It's not that we don't need soybeans. It's just that the marketplace is saying we're going to give you more incentive to deliver earlier than later. And again, when prices go up from, like, for example, November to January, we call that a carry in the market. When it goes from January to March, where there's actually a decrease, that's called an inverse. And I know both Bill and Dave are going to be talking a bit about that. So let's look specifically at what's happening in our three indicators. The first one I'm going to talk about is the Bollinger Bands. And this is, just to explain it and remind everybody. So the black line right now, and you'll see the black bar over here, which is the current trading price at 1476 and 3/4. That price does change periodically. So again, this is live trade. The graphs are updated automatically. So the black line is the current futures trade. Okay, those are the price ranges that we've seen in the futures market. The red line in the middle is the 20-day moving average. So we're looking back at the last month. So again, 20 days. We got 5 trading days in a week, 4 weeks. That's a month. So we got 20 days. So we're looking back the last month and developing an average. So what's the average price we've seen over the last month? So that's the red line. And then we look at how variable has those prices been. So the blue bars on top, blue lines on the top and the bottom represent kind of that typical trading range. We're using, from a statistical standpoint, two standard deviations, which really means that about 95% of the time, based on history, prices are going to be in this range. Okay, so from a Bollinger Band standpoint, what this is saying is, given the last month's worth of trading, there's about a 2.5% probability, 2.5% odds that we're going to see prices above this blue line. And where are we today? We're about 20 cents above that blue line, which is, to me, a very strong signal that, yes, there's a lot of updrafts. There's a lot of interest in soybeans. We're getting this rally, and it seems to be a very, very aggressive rally, especially when we look at today's price relative to the last 20 days. And recognizing the last 20 days have been a little bit quieter, and we've had more of a downward bias in the marketplace. So Bollinger Bands are saying, yes, we've got a rally going on. That rally is very strong, at least in the short term. We're starting to see this 20-day moving average looks like it's bottoming out and starting to come up again. So this is why we call this stochastics, because every day things change a little bit and we start readjusting our modeling. Okay, so let me now scroll up a little bit, or open up. The other one that I want to talk about, and we're going to try and do all three of these in just a moment, is the RSI, Relative Strength Index. So just to remind everybody, RSI is a slower moving indicator. It's something where we're looking back in time, and we're looking at the ratio, the relationship between the amount of up days and how quickly things went up versus the number of down days in the market and how far did we drop. So think of it as a ratio where 50 would be at half and half. So we've had equal up days and equal down days, and the ranges have been very similar when we look back at things. And so this is a 14-day window. So we're looking back the last 14 trading days. The RSI, again, is this ratio. So we're looking at this is a basic signal for not only direction but also momentum. When we start to see, we've seen several, almost a month of time here where there's really been more of a downward movement in prices. Again, that's showing up in the black lines here. An RSI in below 50 really means that we've had more prices drifting lower. And obviously the faster this ratio changes, the faster prices are changing. So we've seen kind of a slow drift lower. We're now seeing this uptick. We're going from into the 40s, into the 50s. We're getting more into a neutral position. But again, recognizing that this is a slower moving average. So this is something that takes a bit longer to adjust over time than some of the other indicators we have. So again, we're looking at direction, but we're also looking at these levels. So if we look back historically, it's very odd or very unusual to have this RSI get reach 70 and, more importantly, touch the 80 mark. So if we look back and what happened in this February time period, we had RSI that was touching 80. And again, it's very difficult for the marketplace to build that momentum and hold that kind of momentum for that long. So typically when we start to see this ratio get into the 70 to 80 range, that's where we typically see kind of some topping action, where we see some prices seeing their highs of that time period, and we would likely see prices drop or soften. So right now, again, this signal is telling us which is a slower moving, that we have had this shift in momentum. We're now going up into the higher range, but we're still just basically getting back to neutral. All right, and we'll look at the final one here, which is the one that I do want to spend a little bit more time on. And that's the one down here with this red histogram. So what we're doing here is we're looking at a short-term average and a long-term average. So the shorter-term average is in blue. The longer-term average is in purple. I really want to focus on these red bars. The red bars is measuring the distance between those. And what this is signaling to us, if it's above zero, if the red bar is above zero, that we're in an upward trending market. And the idea, the concept is that the higher the taller that red bar is, the more upward movement we're getting. So if you notice that markets tend to cycle, and obviously the red bars will follow the black lines just because of the math we're using, but we tend to see these signals. So when we're below, for example, back here, when the red bars were below the zero mark and they were very, very long, very deep, what that's saying is that we've got a downward moving market, and those downward movement is very, very strong. It's a very aggressive downward movement. When we get closer to here, as we get moved through time, we still have the red bars that are below the zero, meaning that we still have a downward trend, but that trend is the downward movement is slowing. So when we look at what's going on today, we're seeing obviously an uptrend, not a surprise to anybody, but the point is that we're also seeing a very aggressive uptrend. So this is one of those signals that tends to be a bit more sensitive to the most current information, just because of the way the indicator was designed and the way that they're doing the math behind it. So think about, again, the Bollinger Bands as being somewhat like an intermediate indicator. This RSI, Relative Strength Index, as being one of those slower momentum ones, those slower moving ones, but again, can give us some pretty good signals on not only direction, but also, are we starting to run out of that momentum? And then this is, I would consider this to be a little bit more sensitive. The MACD, which is the moving average convergence divergence, is a bit more sensitive to short-term changes, but that also provides us some information about, again, what we might be looking for, in particular in kind of topping action, where we start to see prices, the price momentum shifting. So from this indicator, what I'm really looking for in this indicator is, yes, we've got the upward movement. We've got this short-term indicator really taking off. We've got some of the longer-term indicator now starting to turn upwards as well. It looks as though this momentum in the uptrend will last for a while. And when I say a while, what do I mean? Probably in the next week or so. And that's about all the further forward I think we can look at for this particular indicator. But what I would be watching for is when we start to see these red bars, even though they might be in the above zero, when those red bars start to become smaller and smaller, which means that we have this uptrend, but that uptrend is starting to slow. The momentum in the market is still upward, but we're looking at possibly a shift into more of a downtrend. So from a pricing signal, I view it as, given the uncertainty in the weather right now and the concerns about having a really good crop coming in the US and the demand base that we've got both domestically and internationally, we really can't afford to have a lot of slippage in the yield. And so if because of the tighter stocks, if we do have some problems, the market, the pricing system is going to have to work a lot harder to start rationing some of that use to make sure that we still have acceptable or at least ending stocks that are viable. So right now there's a lot of uncertainty. We got some risk premium coming back in the marketplace. So I'm looking at some of these indicators, not only the static ones, we're looking at the support and resistance levels I went through earlier, but also at some of these momentum indicators. Are we starting to see the momentum in the market slowing? So I do expect to see it again over the next, probably into next week. I'm going to be watching this MACD number very, very closely to see, are we seeing a shift? Is that momentum starting to slow? All right, make a couple quick comments on corn. Let me go over and change the graphic here to corn. So this would be December corn. I'll go through the same basic analysis now that we have kind of the groundwork laid. When we look at the black number, that's where the December futures is currently trading. The Bollinger Band on top, we're looking in particular now, it looks as though that 20-day moving average, the red line is starting to flatten and slowly start to curl up. Today's prices are, again, within that top end of the range. So we're touching that blue line. We haven't quite broke through it yet. It's not quite as aggressive a rally in the corn market as it is in the soybean market. But we are definitely seeing this upward trend. And so from a Bollinger Band standpoint, this is one of those indicators that's saying, yep, we're getting a rally beginning. That rally is starting to really gain some momentum. It's starting to get more aggressive based off of what we've seen over the last month. For the RSI, let me just move this down a little bit so that people can see better. RSI is at 46. Again, understanding that 50 is neutral. So we're kind of moving back into that neutral position, but we've come off some relatively low numbers. So again, you can see that the RSI is starting to move upwards. The trend is upwards, but we're really still trying to work back to that kind of neutral position. So again, I just want to remind everybody, this is kind of a longer term or a slower moving indicator. So it takes a little longer for that to adjust. Coming down to the MACD, again, which is one of those that I try and follow fairly closely, make that a little bit larger so everybody can see. We are starting to build some upward momentum. Again, not as strong, not as aggressive as what we saw in the soybean market, but we are seeing this short-term moving average move up relatively quickly. We're seeing the longer-term moving average turn upwards, but slower. Again, these red bars that's measuring that distance is giving us an indicator that we're seeing this upward momentum. But the question is, again, how long will that upward momentum last? So as I look at this, we're watching for these red bars to start to increase, but when they start to decrease again, we're likely getting to some kind of inflection point or a high in the marketplace. I do have just a couple minutes, so I do want to just throw up for you guys that do have some spring wheat. I'll put this up very quickly. Again, a very different story in the spring wheat market. We're seeing a kind of a drift upwards now, where all of the momentum indicators, today's prices are above this 20-day moving average. The moving average hasn't made that curve, that bottom yet with a curve up, but we'll have to wait to see. It does look like it's flattening, so hopefully the downtrend now has been stalled, but we'll get into more of a neutral position. When we look at, let me move this down a little bit. We look at the RSI. We're still well below 50. So it's kind of the bottom half of that range, but it does look like the RSI is moving upwards. When we look at the, this one right here, we do see an uptrend starting to form. But again, the question is that really an aggressive uptrend? Is that something that we can count on and feel comfortable that, yeah, we're starting to get some movement upwards as we move forward? So the question in my mind is, we have the own supply demand conditions for wheat. Corn does have an influence on the wheat market, and I do think some of the strength we're seeing right now over the last couple of days has really been in response to and a reflection of what's happening in the corn market. So with that, just again, a real quick overview. I don't want to go in. I mean, if you want to have some more questions or look at some other indicators, we can certainly do that. I'll stop sharing my screen right now again to try and save some time for any questions, either on the fundamentals or on the technical side.
All right, just another reminder, if you have questions, please put those in the chat. Frayne, I don't see any right now. You must have covered things very thoroughly.
Either that or I burned through it so fast people are still trying to absorb it. So I'll be hanging around for the rest of this session. So if there is something that comes up later, or something that you think of, please don't hesitate to type it in the chat box. I'll try and address it at a later date.
Okay. Sounds good. Well, we have a break scheduled, so we were only going to take a 5-minute break. We have more time, but maybe we could come back at Bill. I've got you on here. Bill, could you start at 9:30 instead of 9:40? Maybe Bill walked. Oh, there he is.
Yes, I can.
Okay, let's take a break. We've got quite a bit more content ahead of us, so let's restart at 9:30. We'll take a 12-minute break, and we will start with Dr. Wilson talking about the basis situation. All right, so it is 9:30. So Bill, if you're ready, we're gonna yield the time to Dr. Bill Wilson from NDSU. Many of you on the call have heard from Bill in the past. Bill is an expert, especially on basis. So he's going to speak this morning about the basis situation and any outlook he has for soybeans in this next marketing year. So with that, Bill, I can see your slides. You should be good to go.
Thank you, Jenna. I love being introduced as an expert on basis, as if I don't know anything else. That's a joke in case you didn't get it. I love having Frayne on the program because it seems though anytime Frayne speaks, then the market starts heating up and we go up 50 or 60 cents. And Frayne was talking, so we didn't see it, but as soon as he started talking, the market started inching up, and then when he quit talking, it stopped. So we can thank Frayne for that. That's another joke. So I want to talk about soybeans and the things and soybean basis, and I'll talk about the current market. I'll talk about inversion market, shipping costs, and Brazil. And I'll finish up with a couple of topics which I thought you'd find of interest. We use the word portfolio of contracts, and then a new thing that's evolving that I think will be important for us to follow in the futures, and that's called wash trades. Then I'll give you an outlook. So just as a perspective, this is something I use in my class all the time, but it shows a relationship between stock use ratios and commodity futures prices. The top one is soybean November, and the bottom one is just average farm price. And Frayne showed to you that in the current crop year, we're probably looking at a stock use ratio of about 5. So that's this is pretty prototypical way of doing analytics in this industry. And when you look at these graphics, a few years ago, we had stock use ratio down around 3 and even 2, and that's what drove those prices up to the $14, $15, $16 range. Right now, we have a stock use ratio looking at 5, and these relationships would suggest a November futures price of about $13.50. Now, when I put this slide together the other day, the actual market was about $13.46. So we would say the market was fully reflecting the expected stock use ratio or expected fundamentals of the marketplace. Or another way to say that, in academia, we call that the markets are very, very efficient. Now, since then, the markets have elevated above that. So unless the fundamentals have changed, we may be suggesting that the futures market is going to be overvalued. We'll see on that. A big story, I think, in 2023 as we look forward is Brazil production. Just as a reminder, last year, going into this time of the year, they were expecting a Brazil production in 2022 of 144. In reality, they had deteriorating crop growing conditions through November, December. They ended up producing 126. Currently, for 2023, the expected production is 149. So that'll be a record large by a lot. That's the USDA number. Safras from Brazil is expecting a number of 155. I point that out to you because we start looking into new crop. into our new crop, which spans into Jan, Feb, March 2023, we're going to be confronting prospectively a very large, by far, very large soybean crop in Brazil, which will ultimately worsen our inversions in the marketplace, which I'll speak to. This is the market from 2 days ago when I wrote this, and obviously the market's up 50 cents since then. So it's obviously we're in a short-term bullish scenario. The lower part is the MACD, which Frayne spoke about earlier. One of the points I want to be sure I convey to you is this concept of an inverted market and the implications for marketing. So on the left-hand side of the graph, we have a constellation of futures prices, March, May, July, where the deferred is always a premium to the nearby. We call that a normal market, or sometimes it's called a carrying charge market. It's called that because that is what we normally think would evolve or emerge. And historically, I would say the majority of the cases we were in a normal market. On the right-hand side in red, you can see the price level. We call that an inverted market, where successively forward futures contracts are a discount to the nearby. So we call that an inverted market. We kind of give an idea that an inverted market hardly ever happens, so don't worry about it. But I have to tell you, in my experience, really in my career, normally we're always in a normal market, and rarely were we in an inverted market. But in the past decade, and I would say since 2008, and concurrent with that, with the emergence of the growth in Brazil on soybeans and Ukraine on corn, we've gone into a much greater frequency of inversions in the futures market. And I would venture to guess today, we are inverted as frequently as we are normal. Well, this is really, really important for you, because as a farmer marketer or marketer of anybody storing grains, is that if you're in a normal market, generally speaking, that's trying to induce you to store the commodity. If you're in an inverted market, it's inducing you to not store the commodity or to sell it immediately. And then when the market becomes even more inverted, it's giving you a bigger incentive to sell on the nearby versus the deferred. And one message I hope I give to you, irrespective of contracts or basis, when we're in inverted markets, the market wants nearby grain, it's paying a premium for it. So the answer is don't store. Now, this is sort of the concept behind this. This is a supply and demand for storage. And on the far left-hand intersection between the supply and demand curve, that would be a negative price of storage. We would call that an inverted market. So we're in an inverted market today. So conceptually, we're where that intersection occurs. So here's something we do in my class, and it's using current prices from a couple of days ago. Obviously, it's changed, but the inversion is not changing. You see July 1473, August 1356, Sep 1346. So we're in a big inverse. What the market is saying is don't store the grain. And if you calculate that out on the right-hand side, we derive the return to storage. So the return to storage from August to September, September to November, you can see they're all negative. So it's a negative price of storage. So it says don't store the commodity. Sell it as soon as possible to capture the nearby premium. Especially now, don't store it from old crop into new crop. So since I wrote that, just this morning, R.J. O'Brien put out this technical chart. This is the spread between September and November. And you can see here, it's gone from about 80 to $1.85. So that's an extreme inverse, an extreme premium for nearby shipping and sales versus deferred shipping and sales. What the market is saying is we want soybeans very immediate. So don't store them, sell them. All right, second thing I want to talk about is the basis. This is my way of depicting the basis. We talk about the different markets in the marketplace. We have a cash market, futures, options, and rail markets pertaining to us. And all of those have both spot and forward delivery position, or spot and forward positions. And what's important here when we talk about the basis is the difference between the futures market and the cash market. And so the basis is very specific with regards to what I call the terms of trade: location, time, quantity, and quality, and place of delivery. So those are the factors that cause this basis market to be varied. And the rail markets nowadays, because of the volatility in the rail markets, both spot and deferred, has an impact on these cash market basis values, which I'll discuss in my presentation. So the factors that impact the bases are delivery charges and convergence of the bases, shipping costs, time to delivery, and quality. So this is my standard diagram of saying theoretically, how is the basis expected to behave? It's basis on the left-hand graph, vertical graph. Horizontal graph is time. And that black line is the theoretical line, or what we think is a theoretical relationship that says that at harvest time, the basis should be very low and that it should increase over time. And that first triangle you see there is called the change in storage cost. Theoretically, we say that basis should increase at a rate equal to the reduced costs of storing as we get closer to the delivery option month. And secondly, on the far right-hand side, you see that word called B equals DC. That means the basis is equal to the delivery charge. During the delivery period, we expect the basis to equal the delivery charge. There's competitive and arbitrage pressures that give rise to that. It really doesn't pertain to us here because we're so far from the delivery locations, but that's the idea. So I've been teaching this a lot of years. This graph is in every textbook. My observation on commodities in this part of the country, and in soybeans in particular, is the basis is more typical of that blue line, where the basis comes into harvest, and then the basis gets shoved down and gets shoved down below the black line, meaning it gets shoved down below the cost of storage, so as to induce and provide an incentive for storers to want to store the grain. Then as we move forward in time, the basis begins to accelerate, and in fact accelerates at a faster rate than that reduced cost of storage shown in the black line. Well, the reason for this is we produce so many commodities, we produce so many commodities in this region of the country. All of them end up being harvested at about the same time. And we got to move grain in and out of the marketplace or into the storage system very rapidly. So when we shove that basis down at harvest, it's trying to induce farmers and elevators to store. And when the basis accelerates in that post-harvest period, it's trying to induce farmers to take it out of storage and storers to take it out of storage and ship it. So this is very drastic, and it's very representative of soybeans in this part of the country. And I'll show you graphs at the end of my discussion, but that rate of increase from the harvest time lows to the post-harvest time highs, in the case of soybeans, is about $1 a bushel. So that's a pretty good return to storage, but this is the theory behind it. So in our trading room, some of you have been here and you know about it. Soybean Council is a big supporter of it. We try to have all of the sources of information available that exists, and these are the ones that we use on the right-hand side. Frayne talked earlier about ProfitX, and these I'll refer to some of these others in my presentation. If you come to our February-March class, we go into hands-on experiences with each of these. So this is a MyDTN. MyDTN is a kind of low-cost alternative to DTN, but they do a nice interactive map, and this is from yesterday. And you can see here a few points of interest. But before I say points of interest, you'll know right now there's kind of some divergencies. For example, Argyle, David will speak about this. They're at 30 under. Just south of Argyle is 65 under. Fargo and Maple, Grain, and Castleton's 50 under, but we got some spots where they're showing -209, -199. I don't know exactly the reason for this. It's becoming increasingly more difficult for these price reporting agencies to report prices. I can only guess that this is a product of the difference between referring to old crop basis versus new crop basis. David can speak more to that when we come around to his presentation. So that's a geographical depiction of the bases. We use Jamestown in my class. Ironically, we use Jamestown because Gavilan hires a lot of our students, and they got a big facility in Jamestown, and we always use those in my university class, and we had a long history of data from there. But now they think that they're smarter than anybody, so they don't like to release this information to people in the industry unless you're a customer. So you can't go to the website and extract the prices, and it's no longer available on DTN. Ironically, this is occurring at a greater and greater number of locations, so that'll be a challenge in the future. So we're using Arthur Companies at AIR on the left-hand side. And this shows the bases by calendar year. And there's a few highlights I want to point out to you. The solid red line in the middle is the average over about 10 crop years. And you can see that we kind of go up to and have a spike in June and July, and then it decreases as we go into the harvest period, and then it increases again. You'll see we had some really bizarre years here. I don't know if you can see my pointer or not, but 2013 and 2014, we had extremely high basis values during July, and those had the effect of raising the overall average during the month of July. I believe that is due to some phenomena going on with ship wait times in Brazil, and it's probably not something sustainable over a long period. So we probably call those outliers. In the current crop year, you'll see this pink line that shows here. Since January, we stopped out here at about -40, and then we declined close to about -60 or 70. And since then, we've been flat. So one of the things we can say, the basis had been declining, and the basis today is about 50 cents stronger than normal. If we said the long-term average is normal, the basis is slightly elevated relative to that longer-term average. So because all of our soybeans, most of our soybeans go to Pacific Northwest, here shows a comparison of the P&W bases. I'll speak into the detail of that in a moment, but you can see that normally in about 2017 through 2020, in that area, the basis of the P&W is about $1 over. As we went into the last couple of years, the basis spiked up to $2 to $3 over. And in recent weeks, it spiked up to about $2.50 over. And since then, it's been falling a bit. Now, this is a little bit nebulous because this is not a easily reported market. The traders or the handlers at the Pacific Northwest no longer report their prices to the price reporting agencies. So we extract these from Thomson Reuters, so they're not perfect. I'll go into detail on that in a moment. But you can see that we've had an elevated basis in the past couple of years, but has fallen in recent weeks. Jamestown is pretty highly correlated to that, but not exactly perfectly correlated to that. So this shows the correlation on the lower right-hand side. Actually, these are numbers from ADM at Argyle, from Jim, who would be David's boss. He shares them to me because he knows we put on these programs. But this is their bids for buying grain delivered to Pacific Northwest. And they're 225 over. There's no bids for the immediate term. I'm only guessing because there's no trading in the immediate term there, but they're buying in last half September plus 225. But then we go into an inversion into new crop to as low as 195 for January. And that's, I guess, what we should be looking at this current crop year. Okay. So I want to speak about Brazil because of the overall overwhelming dominance of them. And I'll point to you how they have such a huge impact on our basis behavior in particular. So this shows, this is from AgriSenses, which is a data set that we use. And this shows through yesterday the bases. These would be FOB bases in green for Brazil, in red for the Pacific Northwest, in blue for the US Gulf. And the amber line is CIF NOLA, so that's delivered to New Orleans. So you can infer the difference between that gold line and that blue line would be the trader handling margin in export position. Now, probably what you can kind of see here is going back into 2020, these basis values were pretty competitive to each other, and there've been quite a bit of volatility here. There's a large amount of seasonality in that green line, which is the Brazilian basis. That's due in part because of the size of their crop relative to storage. You can also see as we go in, I'm going to highlight this later in my presentation, but as we go into 2022, during that time period, Brazil was pretty competitive with the US Gulf, but less than that of P&W. And P&W, in fact, started gaining a premium relative to Brazil. And I'll talk about that in a moment. It's something we're now going to call washout trades. So here's the basis behavior in Brazil, like I showed you in Jamestown. You can see on the top, there's quite a bit of volatility across these bases for different crop years. In the top graph, you can see that red line is their average. So what that shows is that on average, the Brazil FOB export basis on average is about 50 over during the period of time January through May, which is their harvest period. And then going from June forward, it increases pretty rapidly by $1 a bushel to about $1.50 over. And then it begins sliding downwards as we go into the US North American new crop. Now this particular year, we see that gray line on the top, and you can see that whereas normally the base is pretty flat at 50 over from January forward, in fact, the bases went from about 60 over to $1.50 over in a very short period of time. And that is really reflective, I believe, of the short crop or the smaller than expected crop that emerged in Brazil over that time period. So I'll go into detail on that in a moment because it affects us. So I want to show this to you because I try to look at bases from many different views. McDonald-Pelz is a cash brokerage company, and they put out a newswire looks like this every day. And these are FOB bases. Now, for those of you who are farmers in the audience, there's a major difference between track bases and FOB bases. Track is what somebody would sell it for. FOB is what they sell it for in the international market. But looking at P&W, you can see going into September, it's at 352 going to 265 November, and then goes down to 255-ish in January. But take a look at this Brazil basis. It's currently spot at 255, and it declines into their new crop to 84. So I want to highlight that to you, because as I highlight in the yellow down below, their export basis is going from spot at 255 to 84 in January. That's going to put pressure on the bases in North America. And that's reflective of them going into their new crop, expecting a larger than normal crop, which has a downward pressure on their bases, which is going to put downward pressure on our Gulf bases and downward pressure on our P&W bases. I'm sure David will speak on that more later. Here's the forward curve for basis values. So across the bottom, those are different months forward. So that's 1, 2, 3, 4, up to 7 months forward. So let's start at the bottom. The bottom one is yellow. That's the CIF NOLA basis at about $1.10. The blue line would be the FOB Gulf basis, currently maybe at about $1.75, going down to about $1.40. That spread there would be the handling margin. The red line on top is the P&W basis. So you see that's increasing in the nearby months. But that green one, which is probably most important for you, is a forward curve on the Brazilian basis, going from nearby plus 250 down to plus 50 as we're 7, 8, or 9 months forward. I have to emphasize that to you because, as I'm sure in this current crop year, the best time to be selling bases is going to be in the period of time November through January, because once we get into February forward, there's tremendous downward pressure on the world market basis due to this green line that I spoke about. Now, part of the reason for Brazil having all the issues that they have is their logistical problems. Historically, they had a lot of problems with unloading trucks and loading ships in time. We call that wait time. And that's what's graphed here. You go back to 2013, 14, their wait time for loading a vessel was 15 to 20 days at $30,000 or $40,000 a day demurrage. You can see that generally speaking over time, that's been declining, which ultimately has the effect of improving their international competitiveness. So I want to speak a few moments about freight and how freight affects the basis. So I want to be sure everyone's clear on this, that in our rail environment, there's 3 elements of cost. One is the tariff rates. The second is the fuel service charge. I have an error here. This is now canceled. It was canceled for a number of years, but at beginning in January, it was reactivated and now is one of the biggest sources of risk for grain handlers. I'm sure David will speak about that. The second one is the rail car market. So you always hear in the street talk about the rail car market. In my language, I've coined the terms as a primary market and a secondary market. The primary market is when the grain handler buys cars from the railroad. Technically, they buy a certificate called a Certificate of Transport Services, stands for COTS. They buy that instrument on weekly auctions that allows them to make commitments 12 or more months forward to the use of a train. And then if they don't need the train, they can sell it in a secondary market. Or if they want to use the train to acquire grain, they can use it for acquiring grain. Or if secondary markets go to high value, they may decide to sell the train in the secondary market. So normally when you hear about the rail car market, you hear about the secondary market. So here's a picture of the secondary market from 2012 until current. So you can see this extreme volatility. These are in dollars per car. We call it DCV, daily car value. On average, over this long period of time is $225 a car. But it ranges from a low of about minus $200 a car to as high as $5,000 a car. Now, $5,000 a car is about $1.75 a bushel. So that's a lot of money. And typically speaking, this volatility is caused in part by weather or something unexpected happening in the market to shove those values up. And though people can complain about high secondary car market values, there's two characteristics of it. If the price goes to $4,000 a car, somebody's making a lot of money when they sell that car because they probably bought it at zero. And secondly, if it goes to $4,000 a car, probably somebody's short rail cars. They're short rail cars because they underestimated their demands, something like that. So that's the current market. You can see that we spiked up early this year. We spiked up from less than zero to a high of about $3,000 a car, and it quickly fell down back to about zero. So one of the important things for you as farmers and grain handlers is the secondary car market values affects the basis value, but affects the export basis value different than the interior basis value. What I circle in this figure here is a correlation between the basis at Portland and the secondary car market value is 0.42. And on the right-hand side, I can't see it, I think the value is minus 0.21. So what that says is when a secondary car market value goes up, it affects the Portland basis and affects the origin basis, but has a greater effect on the Portland basis than it has a negative effect at the origin basis. So here's the current market from Monday this week. We track these very carefully. This is the Mulselman Company. You can see that these are bid-ask spreads in this marketplace. So in the nearby, we got negative values, meaning that they're extremely cheap. But as we going forward, we gradually increase and reach a peak in this October period. You can see there's a wide spread there between the bid and ask. On average, this number is typically about $1,600 a car, so about average for that deferred period. And that remains a spike until we get into probably February, March. And really what that spike is looking at is a big harvest time and post-harvest time movement primarily of soybeans and secondarily corn. Another secondary market is commonly called Trade West. That's a cash brokerage company in Portland, Oregon. These have been friends of mine from the beginning of time, and they share with me their bid off or spreads. This is the current market from, I think, on Monday this week. And you can see nearby, they're somewhat comparable, negative values in the nearby months. And as we go out into October, November, December, the range is $1,600 to $2,000 a car, meaning a high secondary car market value, meaning a lower interior basis at that time period. And as we go into the later time periods, we get into Jan, Feb, March, and we really don't see any trades or offers until we look at a package of about $450 for Jan, Feb, March, and minus $200 in April, May. Well, this is the lifeblood of people like David and ADM and CHS, and I'm sure he'll speak more about that, but it has effect on the basis as I described. I have to speak on China. Frayne talked about them because they're so domineering. Just so you know, this red line here is Chinese imports. They're at about 100 million metric tons right now, growing rapidly. By far, of all commodities in the world, this is the fastest growth rate of any other commodity in the world. And well, this shows the behavior of it. From a Pacific Northwest perspective, these are Jenna's graphs. She does a great job putting these out every week. And you can see the importance of China. And that's their imports over a number of years. And I'm on the Soybean Council board, and we discuss this all the time, because if we lose China as a market for whatever reason, political or economic or whatever it is, the next biggest markets are not very big, as you can see in this graph. That's the importance of China. This is Jenna's graph. It shows here the seasonality of exports. The black line on the top graph shows that this past year we've had record high shipments out of the Pacific Northwest relative to all of the years, but they peaked out in October, November, and then fell off with a slight spike in February, and then we went down to nil. Looking at April, May, June, merely because of the harvest period of Brazil, I'm sure. This is a Thomson Reuters graph, and I want to show you on the lower left-hand side our Chinese imports from the United States over a number of crop years. And you can see that their imports from the United States are November, December through March, April, and then they dissipate, go down to about zero. So I keep track of these very carefully, and I'm going to move that. Okay. I keep track of their rate of purchases. And this data is partly from McDonald-Pell's, but it shows on the left-hand side the Chinese monthly expected demand. So you can see that's their demand projection, totaling for 22-23 about 99 million metric tons. And then it shows their current purchases to date from the US in blue, from US, Brazil, and Argentina, and the total. And on the far right-hand side, I show their ratio of coverage. We call that the coverage ratio. So that number 0.08 says that the Chinese as a country are 8% covered for September, but they're covered 29 and 52% for October, November so far. And then they dissipate and go down to, until we get into March, at a coverage rate of about 37. So you see they've taken big coverage already in the new crop months in the United States and the new crop months in Brazil. But all in all, they're only 17% covered for 22-23. I've been following this for a lot of years. This is an abnormally low level of coverage by the Chinese importers. I can't show it to you now, but this is abnormal. Normally, by this time of year, they would have more coverage. What that means is they have a lot left to buy. They have a lot left to buy in September. They have a lot to buy in January. They have a lot to buy for April forward. And so at the competitive environment here, that September month will now become very competitive between the United States and Brazil, and will undoubtedly have an impact on the basis. So just yesterday, I read from US cash broker, here's what he said. He said, reports the China's purchased last week 25 cargoes off from Brazil. Interestingly, the trade estimates see Chinese August coverage as complete. So they're 100% coverage for August, with October, November at 40 to 50%, but September close to zero. So that's approximately equal to the numbers I just showed you. Okay, so sometimes people want to talk about going someplace other than Pacific Northwest. The PNW dominates our market by far. The next best alternative in most cases other than domestic would be St. Louis. St. Louis is hardly ever competitive with Pacific Northwest. I've been doing this a lot of years, and today, using relative values, this is a chart I keep track of for September 22 and January 23. By far, PNW is the best market, both in the nearby month at $1.37 versus -17, and by far in January. I'm sure David will speak about this, the appeal and attractive of Pacific Northwest. Okay, I want to mention something to you, and I don't know if you've heard this before, but I've observed an increased frequency in the trade of something called a wash trade. And I want to articulate this to you because it has an impact on the basis internationally. And I think it's exacerbated by the way the Chinese are dominating this market. But this happened in a big way on July 5th, which I'll show to you in a moment. So the concept is the buyer has an outstanding contract with a specified origin, say United States. So I'm China, I bought from the United States, say for August or September delivery. And then over a period of time, the FOB basis relationships change. Maybe Brazil becomes cheaper than the United States. So then the buyer renegotiates their contract. It's called a wash trade, which means they uncommit from the original origin and take a position at the alternative origin. So in the example I gave you, maybe the buyer bought for September shipment from P&W, Brazil becomes cheaper for September, so they buy themselves out of P&W and acquire the grain from Brazil. This happened this year in July, on July 5th. I'll show you the press release in a moment. And so you can see on the right-hand side, the red line is the Pacific Northwest, and this green line is Brazil. And Brazil had increased relative to Pacific Northwest, and then it started declining, meaning Brazil became more attractive, and then there was a wash trade. And it was said, I'll show you the press release in a moment on the next chart, but the effect of this is put downward pressure on US values. Of course, it could operate the other way around. China could buy from Brazil for shipping in May, and then May Brazil goes to premium relative to P&W, and they wash it out and shift it to the US. Here's the press release. I'm not going to read it all to you, but on July 5th, this occurred. I went back to my records. It's been occurring with greater frequency in about the last 5 or 8 years. So it says here, on that day, Chinese buyers canceled at least 5 cargoes sold from the US last week in a process known as a washout. 3 of the August cargoes had been booked out of the US Gulf, 2 out of the P&W. So what's that mean? The exporter sold to China, 3 shipments from Gulf, 2 from the P&W, and now they're going to liquidate those positions, which puts downward pressure on US Gulf and P&W bases, and they shift those to Brazil. So in the 4th bullet down, it says Brazilian bees are more competitive than those out of the US, even for September shipment, which is uncommon considering seasonal factors. The US typically is into its harvest period, then when prices usually press to increase supply. On the right-hand side was a commentary from my friend, Jeff McPike, who explained to me his interpretation of this. You can read it when you see the slides. But it's pretty interesting phenomena. I think it's a reality trade. I want to say it's probably not good, because really what the exporter is doing is giving the importer the option to switch origins anytime they want to if price relationships change, because that has a subsequent adverse effect on the original origin. I'm sure we'll hear more about that. So in my class, we teach about risk, and we have a model I'll show you in just a moment. If anyone's interested, I'll share it to you, but in our February class, we share this and distribute it. But we talk a lot about futures, and our focus and eyeballs are typically on futures as our source of risk, not paying attention too much to the bases and the risk in the bases. And one of the things I'd like to leave to you is the basis is really risky. And in reality, sometimes the basis is just as risky as is the underlying futures. So the key variables that are important when we talk about this is the risk in futures, the risk in bases, and the correlation of bases and futures. So here's some charts I did yesterday from Jamestown. And so they're derived in our spreadsheet. One of David's friends from graduate school prepared this. And on the top left, this is Jamestown, or Courtney, North Dakota. So the blue line and the red line is futures, and Courtney in particular from early March until current. Now on the lower left-hand side, this is the basis at Courtney. So you can see that basis crashed pretty sharply over this time period from around 50 under to drastically, they show in DTN, to as low as $2.50 under. That may be a reporting error, but this is the way the data comes out. So on the upper right-hand side, we derive the standard deviation. So that's a statistical concept. We do it automatically. We use a 21-day. So what this is a measure of risk, in particular, 21-day risk of changes in the basis and changes in the futures. So you can see, firstly, since March until current, that basis risk has increased substantially from about 0 to 10 to as high as 60 or 70. So there's lots of risk. Secondly, the red line is futures, the blue line is the basis. And you can see that really over most of this time period, there was as much risk in the basis as there was in the underlying futures. They were comparable. So though we spend a lot of time talking about the futures and hedging and futures to get rid of risk, we have a lot of risk in the basis as well. Now, in the past few weeks, the risk in the basis has declined somewhat, and that in futures has escalated. So in the lower graph, and this is pretty interesting, this is a correlation between soybean futures and the basis. Now, most textbooks, when they talk about, they don't talk about this topic because they assume, I believe implicitly, that there's no relationship between the basis and the underlying futures price. What I've learned in teaching this over time, and on this spreadsheet in particular, there is a high degree of correlation between the basis and the futures. It has very dramatic impacts on what would be an appropriate hedging strategy. So you can see here over much of this time period, say in that time period from around in June-ish, in that area, April, May, June, that correlation was positive at 0.5. Whereas in the past few weeks, that correlation is now negative. Well, what that means, a negative correlation, it says the futures goes up, the basis goes down. Well, that is obverse of what you want to happen from a hedging perspective. You know, ideally you want to hedge and the futures goes down and the basis goes up. But when we have a negative correlation, we have just the opposite effect of that. So we have a spreadsheet which does a pretty complicated calculation of risk, defining risk. And I want to illustrate this to you. We call it a portfolio of contracts, and we allow the spreadsheet to choose, should I hedge in futures, forward contracts, HTAs, no price established contracts, or basis contracts. And just for illustration here, this is a Jamestown grower with 50,000 bushels. And we assume their production cost is $239,000. And their sources of risk are futures basis and the correlation between cash and futures. So on the right-hand side, in those green bars above, those are the current values from yesterday, the basis and the futures. And then look at the numbers of standard deviation. The standard deviation of futures is 0.77, standard deviation of basis is 0.56. What that means is both of these are risky. In reality, they're extremely risky, and the basis is just about as risky as is futures. So don't ignore the risk of this basis. And then on the right hand, it says that the correlation as of yesterday was minus 0.57. That has a very dramatic impact on what is an optimal hedging strategy. So on the lower right-hand side, I show the results. This says that if I were 100% hedged, my standard deviation of profits would be $32,000. Okay, so what that means is shown in this probability distribution I show above there. It says with a 50% chance, my profit will be $437, but it could go down to as low as maybe with a 10% chance, it could be as low as say maybe $410,000. And it could go higher. We could have a higher profit, but with a low probability. So that's the way we look at it. Now, if I were 100% hedged, or 100% hedged, I lower my standard deviation from $32,000 to $28,000. That's not a lot. You know, sometimes we say, well, hedging the futures market, you eliminate your risk. We've not eliminated very much of our risk by hedging. And the reason for that is because of that negative correlation between the basis and the underlying futures. Now, interestingly, when we taught this exactly a year ago, right now, that number that I talked about, instead of being 28,000, would have been $9,000. So even if you're 100% hedged, we have a lot more risk today than we would have had a year ago. And that's due to this high volatility of futures and basis and the negative correlation. Now, interestingly, when I determine what is the optimal hedge, you know what it is? hedged 50% in the futures market and 50% with a basis contract. And that gives a standard deviation of profits of 16,000, which is the lowest technically possible. Pretty interesting. Okay, so just to go on, people ask me, how do you project the basis? All of this stuff is seasonal, all of it is risky. What I teach in my class is two ways to talk about projecting basis. One is the MACD, which Frayne talked about a moment ago. The other is seasonality, and I'll show you a chart of each, then I'll draw closure. So Frayne talked about the MACD and futures contracts. Ironically, this particular spreadsheet was created by a student of mine, I think a classmate of David's, Stefan Johansson, and he was really, really good at spreadsheets. And he found a way to derive MACD automatically from the data provided on DTN. And ironically, he created that in 2012 and 13. We use it in my class, and 2 years later, it's a icon button on DTN and on bar charts. So this is the concept behind the moving average MACD. Dave or Frayne spoke about it. So here's Kensal, North Dakota, and this is from January 22 until current. This is out by Jamestown. In the upper part of this graph, this is the basis as reported by DTN. So you can see it's gone down to as low as 85 under to as high as minus 40 under. So that's a pretty wide range of the bases in a very short period of time. And on the lower part of this graph, it derives the MACD. This is done with a click of a button on DTN and on my DTN and not on bar chart, I'm sorry. And so this is the MACD of bases. Frayne just lectured to you this on futures. The same exact concept be applied to bases, because what we're looking for is a turning point. And what this shows here is back here at about March 28th, we had a positive turn to the upside on the bases, and then a correction, and then the basis here on this date, about June, I guess, 13th, a positive spike in the bases. So we're identifying turning points, and then commencing with this date here, the bases began a slight decline, not over radical. Here's the new crop bases at Kensal, and you can see after falling from 44 under to 62 under, it's pretty flat, meaning that there's no reason to believe it's necessarily going to go up or go down from current values. Now, because David's the most popular guy in the world and works at Argyle, here's their bases. David, I'll teeing this up for you for your presentation. This is their new crop bases. Back here in February, they were about 24 under, and then they lowered it down to about 45 or 50 under. And then they rose it back up and then back down to 40 under, and currently at 30 under. I think that's what you told me earlier. But you can see at the MACD on this. This is their new crop. On March 28th, we got a positive signal of it moving up. And here again, last week, I guess July 18th, we got a positive signal of the basis spiking upwards, which is exactly what we see happened here. I'm sure David will speak more on that as we go forward. So I'm going to then, we do a lot on seasonality in the basis. And let me point out that all of these basis values have extreme seasonality. They have a huge impact on what is the best marketing strategy. So this is soybeans in Jamestown from 2010 until current. And this red line is the average basis. So you can see on average, that basis reaches a low in July, and then it increases from about minus 120, and increases rapidly and reaches a peak in January at about minus 75. And then it peaks out in January, and then it begins to crash. So what's going on seasonally? Here we got farmers selling due to new crop harvest in the northern tier of the soybean belt. And during this time period when the basis increases rapidly, we have the marketplace trying to extract grain out of the storage system. To do that, it raises the basis. Then it peaks out in January, and then it begins to decline. That just happens to be commencing of harvest in Brazil, and the decline in the basis as they go into their post-harvest period. But from a farmer marketing perspective, this is, I kind of want to say, a no-brainer. If you've not sold new crop basis, what it says is you probably want to harvest and store the commodity as we go into the harvest season. On average, as we go to the post-harvest season, you should be looking to sell the cash grain in December and January, but by absolutely, you should not be storing it beyond January, February, because of the downward pressure due to the harvest of the Brazilian crop. This year will probably be more dramatic of this than normal because of the anticipated larger 23 crop in Brazil, which I discussed earlier. Okay, so I guess I'll just maybe close. And this is a chart from Illinois, and they did what we did. And I don't want to say they copied us, but we did this on wheat and soybeans and corn. But it's a recent one, not so recent, I guess, but they did identify when are the typical low bases. And they said the most likely low bases is July, August, September, and October. So that'd be the seasonal lows. So from a storer perspective, that's when you want to be buying grain to store or keeping it off the market and storing it into the post-harvest period, which I said for this part of the country typically means December, January. So just looking forward, my last comments. In 2022, major risk, we got a big inverse that's becoming more inverse as we speak. That says don't store, don't store, don't store. Basis is slightly stronger than normal, probably due to the strength of the bases in the 22 crop bases from Brazil. There's pressure for it to decline. There's going to be seasonal pressures for it to decline. And a lot of this depends upon the timing of future Chinese purchases, which I highlighted earlier. I think looking into 2023, I think the biggest risk is this large, currently anticipated Brazilian crop at 155, which will be by far a record. And currently the paper market says that basis is going from current 240 to plus 50. So that's a $1.90 decline in our competitors' basis. That's going to put downward pressure on our basis January forward. So currently, unless the supply and demands are changed, probably the futures are getting a little bit elevated for stock use ratio of 0.05. But we're still in an inverse. That means don't store. It's really hard to project substantially higher futures than current unless we say something's going to happen to that stock use basis. We're extreme volatility. Frayne talked about that, so I won't elaborate on that, but I want to stress something right now. The volatility of the futures in recent months has gone from 20 to 42. So normally it's about 9. So we went from a high level of volatility to 20 to 42. It means we're twice as risky as we were even in March of this year. So is soybeans risky? Yep, they're risky. They're twice as risky. But importantly for you, we have a lot of risk in the bases as well. And that means that even by being hedged, our standard deviation or risk is substantially greater than it was last year. So with that, Jenna, I will unshare. And if we have questions, I'll try to answer.
All right, I'm watching the chat again. Don't have a lot of questions from this group this morning. But Bill, are you staying on all morning?
Yeah, I'll be on all morning.
Okay, great. So for any of our speakers, we still got Frayne on too. If you all have questions, just feel free at any time to put those in the chat and we'll address those. So with that, David, if you're ready, I'll have you share your screen. So today, giving our industry perspective, we have David Hertzgaard from Marquette County Grain. David's the location manager for Marquette County Grain in Alvarado, Minnesota. He's a past graduate student of Dr. Bill Wilson's, and he has extensive experience with soybean markets. So David, with that, I'll yield the time to you and I'll have you go ahead and get started.
Sounds good. Thank you, Jenna. Yeah, as she said, past student of Bill Wilson, entered industry after that, spent some time in the Mississippi River Valley in Missouri and Arkansas and Mississippi and moved back to Grand Forks here, currently working out of Alvarado, Minnesota. Market County Grain is a joint venture with ADM. We run a shuttle loader in Argyle and Alvarado, as well as have some ownership in the Barnesville elevators. So with that, I'll kind of get into it. Today, I'm going to take you through just a brief market overview, kind of a lot of stuff that Frayne and Bill have already talked on too. I'll go over a brief U.S. Supply and demand here. Oops, looks like my screen didn't switch.
Yeah, we can't see your slides right now, David.
There we go. Yeah, take you over a brief view of supply and demand, just touch on what Frayne already talked about mostly, just to kind of frame some of my discussions here. I'll talk about crop progress, what we see with the current soybean crop in the US and North Dakota as well. Then talk about some other key issues. Again, a lot of these, Frayne and Bill have touched on too, and I'll go over briefly Ukraine and Russia and impacts there and what it might mean for markets. We'll look at fuel pricing and concerns there, how it relates to freight and your operation potentially too. I'll touch a little bit on basis, try to leap off of what Bill has talked about here and address some of those. We'll talk about freight performance and issues that we see in the elevator system, what it might mean for basis pricing levels and execution performance at harvest time. I'll talk about foreign exchange challenges as well, and then give a little bit of update on on-farm marketing and what might be there. So,
Hey, David, we're still not seeing your slides. I don't.
No, you aren't here.
Yeah, did you hit the share screen at the bottom?
I believe I did, but let me double check.
Okay.
I apologize.
It's okay.
Here.
Oh, that
How
looks
about
better.
now? Perfect.
We just have to have you, it's in presenter mode is the only thing, but once you get going here.
Yeah, let me see. I apologize here.
You're probably working on multiple screens, which is always,
Yes, I am.
yeah.
Give me a second why it's not working.
For everyone on the call, we tried this earlier and it worked perfectly.
It worked just fine. Let's see, let's do this. Slideshow. Let's see. I'm struggling here. Do we want to take a 5-minute break, Jenna? Would that be okay?
Yeah, so I think I saw just a little bit and then you moved it off to a different screen. There's a display
Here.
settings option and then there's a swap. And that might fix what you got going on.
Here we go. Let's do. Any luck there? It shows that it's sharing on my screen here.
So we can see your market overview slide selected. We don't see the full view, which is fine. I mean, it's big enough we can see it if you want to just continue to click on the slides that you're looking at.
Yeah, let's just do that if that works
Okay,
for everybody.
that sounds
Okay.
good. So right now we see your title slide.
Okay.
Okay,
We'll
great.
continue with the market overview. Oh boy. It's not wanting to work for me here.
Or if you want to email them to me, David, I can, oh, that looks perfect.
There we go. Now we got her. I
Okay,
apologize for that.
No problem.
So, okay, we'll jump back in here to market overview. U.S. carryout is comfortably tight. I think Frayne talked about that. It's kind of like how he describe it. Prices have rallied, the last 12 to 18 months. This growing season, early weather concerns supported market through spring. Conditions have improved into the summer months and they're favorable at this point in time, I would say. There's still some weather risk out there, that exists. I think we're seeing some of that in the recent rally, and the potential heat we got coming up here. Markets moved to a bearish sentiment and technicals have driven them down, recovering a little bit here. There's a few weather concerns out there, but I think overall we've got some optimism for new crop supplies and what we see come online. In the current market downturn, we should be looking for market signals that signal some sort of reversal. And with the pricing this week, it'd be good to look into it and see if we're establishing any new trends here in the soybean markets and other commodities as well. So just brief production carryout again for 2023. We're looking at 88.3 million acres. we're really looking at yields at this point in time, projected at 51.5, right along trend line there. And if you look at carryout numbers compared to last year, we're in a pretty similar state. There's a little bit bigger carryout, but again, in a range I like to call comfortably tight, where we've been there before, but any hiccups in production, it could have impacts to pricing that we see. Total U.S. soybean supply, it's pretty similar to what we've seen the last few years here, not a lot of change. So from a production standpoint, again, we can see ending stocks here. The last few years we've been in that 225 million bushel range, a far cry from 2018 when we had trade dispute issues. We've kind of dwindled our carryout numbers there. On the demand side, old crop and new crop soybean demand has remained strong, and I suspect to see the same thing through 2021 here. Again, here's soybean exports of U.S. Again, if we compare it to the last couple of years, we expect good soybean demand coming out of the United States. Again, just to kind of emphasize that supply is going to be strong and demand will be strong. Again, I think Frayne shared some of these similar slides showing usage between export, domestic, and residuals. Again, pretty consistent with the last few years. So I think the big takeaway and kind of what I want to get through is that we're going to have good supply. All things stay the same here, and expect to see good demand as well. So crop progress to this point, this is a nice chart here. You get a good idea of what crop conditions can look like at this point in time. On the middle chart here, it shows good to excellent for both North Dakota on the left and US on the right. Both are about 60% good to excellent right now. So I think that speaks to being a pretty decent crop. On the top chart of both of these, you can see the 2021 in orange or yellow there. You look at North Dakota, I mean, we were, I think, at 21% good to excellent this time at last year. Just shows, how the drought affected things. More so on the US side, we were about 60% good to excellent, so pretty consistent on everything. Continued, this is last year's progression of good to excellent here. Again, it kind of covered a little bit of that, but North Dakota really struggled at this point in time. While the U.S. had better crops. So again, I think we're going into a good year for production without any weather concerns here going forward. And again, kind of showing where we're at for crop progress at this point in time compared to last year. Frayne shared some similar maps to this, but I'd just like to look at it and go over and kind of see the drought considerations we had for last year and our moisture level and vegetative health index here. You can see on the right, you can see the areas of stress. They jump out pretty drastically here. On the left, we see much better vegetative health compared to previous years. There are some areas of stress, as Frayne alluded to. But overall, I think we're in a much better spot than we were last year, particularly in North Dakota, when we're looking at the North Dakota crop. So we'll move on. Russia-Ukraine conflict. I am not going to take a whole lot of time to talk about this, but I think it's important to note. There's a lot of outside factors that are really driving our market at this point in time, and this being one of them. And last Friday we had an agreement became between Russia, Turkey, and Ukraine to open corridors for shipping grain into the global market. So I think there's still questions out there to what that means, or if Russia will hold up their end of the bargain. I think that there will be exports that will be coming out of there within this agreement, but days after signing the agreement Saturday, there were more bombings of ports in Ukraine. Now that doesn't mean a whole lot, but I think in the market it breeds uncertainty in what's going to happen and what it means. So, and that's all you need. It's not direct effect of always what you're exporting or shipping, but it's the market's viewpoint on it. And so I think it breeds a lot of confusion in the market. And there have been exports coming out of Ukraine that have been moving by rail, but nothing near the capacity that we typically see. So again, try to drive home that uncertainty is high, and what's going to happen with global trade flows and how those agreements are going to iron out. And in the current geopolitical environment, we can expect volatility to remain high surrounding this. So, keep your ears open for news on what's going to happen and how it may affect global markets, because it's going to be going forward. It'll be a big issue. I also want to touch base. So fuel prices. I didn't get into any oil pricing, oil charts. I mean, we all know kind of what's happening there. Frayne talked about a little bit, but what is significant is, you know, what impacts do high fuel prices have on us in the elevator system and on you as a grower? As you can see here, Bill talked about fuel surcharges, how he went away. You know, we've dealt with fuel surcharges for a long time before, and sometimes they're impactful and sometimes they aren't. I put together here what we're seeing on fuel surcharges. You know, in 2021 on the right side here, fuel surcharge per mile was 23.5 cents. Now this is from my location. It'll be different depending on where you're at as far as miles, but you know, we are at 23.5 cents fuel surcharge per mile. This year we're at 72 cents. That's changes of over 300%. And if we look at the direct impact, I mean, that's almost 22 cents. As freight, as basis being a component of freight as a component of basis, we're seeing those numbers kind of weighing on basis values to some degree when we look at it. So, but if you look at those numbers per bushel, that's the cost of shipping freight, you know, from the valley here essentially to the P&W. So it's pretty significant when we look at it here. You know, and it has had implications on basis, and it will continue going forward. It's going to be pretty drastic. So, so yeah, and Bill sharing values with you before on freight. You know, typical freight values we see at harvest at $1,200 a car. Well, those freight charges or surcharges are double what the actual car costs are in the secondary market. So it is a significant factor when we look at it. To kind of relay that into basis values here. New crop basis values are historically high levels. If you look, this is our harvest basis only historical basis chart here. The pink line on top, that is our current basis through mid-July here. I think across the state and some of our growers that are on with us here, I mean, you'll see between 30 under and 65 under for November. I'm focusing on 30 under here. That's probably what your typical competitive shuttle loader will have as the best bid in the market. And you can see that is our historically high level here. You can see last year, the brown line right underneath the pink one, that was our basis last year. We did see competitive compared to this year, pretty competitive values there. But again, that was a drought year in North Dakota when there wasn't a lot of crop out there comparatively to this year, what we anticipate seeing. And so going into harvest, what you see is, you know, basis strengthening going into harvest, which is pretty atypical. You know, as an elevator manager here, we typically see basis fall apart once harvest hits. That's due to crop size, you know, timing of the crop coming to harvest, and a lot of the freight implications that we see there. But you know, last year going through a drought, we see basis values improve because freight values fall apart; they don't firm up like you typically see. This year, I think it's a different story. I think we're going to see a good deal of grain come into the elevator. I think we're going to see a ton of pressure coming off the combine, and I think freight is going to respond accordingly. Harvest delivered bids to P&W. Again, Bill had some pretty good slides there that kind of illustrated that, but they're also at all-time highs here. And I think they're going to remain that way. And to me, it's really difficult to see values firm beyond this point. And a lot of that is due to what I anticipate happening in the freight markets, fuel surcharge prices coming in as well. So I think right now, I don't like to make a lot of price predictions, but at this point in time, I don't think we're going to see a better basis value. And if you have grain that you're anticipating you'll have to deliver into the elevators at harvest time, I would highly recommend looking at locking some of those in right now. And even this morning here, I've had a couple producers that I've spread that message to and have done so. So I would recommend it. So what's going to happen here on basis and what we see, and who pays freight and who pays for the fuel surcharge? You know, it really depends. If we get into this crop and we get an early frost or something happens where there's not much of a crop coming, and exporters are really demanding a lot of beans now and they're not getting them, you know, we'll see a lot of the export elevators have to increase their bids in order to cover some of those fuel surcharges. But what realistically is more so going to happen is we're going to see good crop come off the field. The exporters are going to get their fill, and we're going to see these fuel surcharge rates and high freight rates impact basis and move it lower. And historically, that's what we see. So I would anticipate the basis to fall apart after this. Again, getting into talking about harvest delivered and talking about deferred delivery, our December delivered basis is 30 under. It's the same as our harvest deliver. However, it's bid off the January futures. So there is a carry in the market that we're seeing right now by about 6 cents. You know, we talked about carries and inverses, and Bill brought it up, and Frayne did too. We see a carry to December, and a lot of that is going to be in freight pricing. When we see the most expensive pieces of freight come in at harvest time, the market is going to try to push demand back to a December delivery rather than a harvest delivery, just because the execution of freight and the cost is so high that we'll try to increase bids for December delivery, and that's what we're seeing right now. And so I kind of anticipate one of two things happening at harvest is either, you know, nearby harvest delivered bids, so your October, November delivered will fall apart, you know, move to a 30 under to a 50 under or something like that. Either that, or we'll see that December delivered basis improve. So there's two mechanisms as an elevator operator that we use to try to determine when grain comes. That's either, you know, lower the basis and try to defer delivery, or we'll increase the deferred bid. So at this point in time, I would assume the front end here will kind of back off a little bit. And then as we look at our January delivered bid, you can see the inverse start to come in there, where we're bidding about 5 cents worse for a January delivery. And so that structure may change as well, depending on the pace of harvest, depending on what freight does. If we see, you know, demand for freight increase in that October, November, December period, you know, the market may push deliveries back even further. And again, there's a lot of other factors going to jump in there. It's going to depend on South American harvest and when that comes online, and how exporters feel they're getting the crop coming into their Pacific Northwest delivery stations. So a lot of variables there, but you know, that inverse will be coming there. And right now the market is kind of indicating that the winter months, you know, are going to be the best time to deliver crop here. So just a slide added on here. Bill had mentioned, you know, he was looking at some basis values and how they kind of look out of whack and what we're looking at. So currently, you know, we're bid 30 under right now against the November futures. You saw negative 209 out there. My suspicion is that they're bidding off of August futures, which you can see is at a much higher premium. Again, that inverse from old crop to new crop here. So we're looking at about 209 under, I think is what I caught from Bill's presentation there. If you look at the cash price, they're very similar. So a 30 under delivered price against the November futures is going to be, you know, almost essentially the same cash price for you know, a 209 delivered off the August futures. And it's really interesting what's happened in the soybean market. It's happened the last couple of years where we've had tighter carryouts, and as we get to you know, the later summer months, you know, there's less supply out there, and so we see higher prices on the futures months that trade in the summer, particularly the July futures. Well, we get this big inverse built into November futures where the pricing is lower, and everybody says they want grain in the last months of dying months of the summer here. Well, at some point in time, whoever's holding on to that grain is going to eat that inverse. So right now from August to November, there's roughly not quite a $2 inverse there. At some point in time, the elevators run out of cash markets to find to sell into, as everybody waits for new crop to come online, which is a cheaper price essentially by the futures pricing there. And so you start to see these basis numbers kind of get out of whack a little bit with that big inverse. Realistically, the cash price doesn't change a lot, but the market is trying to converge into a new crop price essentially, where you see wild swings in the basis. So it's important when you get big inverses in the market to understand what's happening on a delivery front, and if you can get out ahead of it and deliver before, you know, you run into a steep inverse. So just some notes there. Other fuel implications here to consider on the farm, you know, liquid propane and natural gas costs. What this does to your drying costs on farms or at the elevator. You know, we haven't made any adjustments to our drying schedule for new crop, but I fully anticipate that we will. And with increased fuel costs, this could be potentially 20% increase to drying charges. So locally speaking, for our elevator, we're pretty lenient on drying charges off the combine for soybeans. I would look for that to change a little bit just with the increased cost of everything here. So it's something to keep in mind, particularly with a later planted crop that we have here. I do believe we've caught up in our crop progress and how it looks, but if we end up with a later soybean harvest here, there's a better chance that we're going to be dealing with some wetter grain coming off the field. So it's something to consider when you're binning and storing grain. We talk about storage costs and what the market's willing to pay. You should be able to take a look at your on-farm, storage costs, and you may have to do an overhaul on it. Just additional miles and diesel fuel when hauling, what it's going to cost, and electricity for running fans or propane to run your dryers if you do so. It's important to look at this point in time with impacts for rising fuel costs. Again, the US dollar, Frayne talked about this a little bit, and I think it's extremely important to look at here and what's happening with the markets. US dollar remains strong. I've got a chart here on the right side. It's kind of tough to see, but this stretches all the way back to 2008 at the very left-hand side of the chart here. I think we were at 72 points on the dollar here. Today it sits right at about $1.06, and I think we rallied up to $1.09 in intraday trading. That's a significant increase, and even I'll show you on the next slide here on some daily trading here and what it looks like just recently. But this is negative for any exporters. This is not a good sign for what we see. It's all tied into geopolitical uncertainty, what we're dealing with. Recession has been thrown around, and what we're dealing with high oil prices, Russia-Ukraine conflict. This is kind of some of the fallout from that. The dollar is seen as kind of a safe haven instrument, a lot of money falling into it, trying to find somewhere to put your money where it's not at risk so much. So, but there's negative impacts for competitiveness of exports here. You look at soybean or South America harvest and when they come online, China's going to be licking their lips when they can get a hold of that, just because of looking at the US dollar and what it means for impacts for them for what they're buying and how much it's going to cost. So it's good if you're traveling overseas, but as an exporter trying to sell a good amount of goods out of the United States, it's a negative tone. Again here, we can see some trend line support here. I'm not a foreign exchange or currency trader or anything, but it seems supportive on some of the trend lines here where we're at. Frayne mentioned it stabilizing, it very well may have here, but I don't see any bearish momentum a whole lot just looking at this. So I believe there's some trend line support. We could break out of it, but I think it's going to be a persistent issues, recession issues continue. And again, try to drive home, same with the Ukrainian conflict, is that these outside markets are going to continue to drive commodity pricing here, and they need to be noted pretty well. So to get back into freight here again, freight has been difficult the last 6 to 12 months, probably 6 months really. Our freight capacity has been diminished on the rail here. Car performance has been 4 to 6 weeks behind schedule. That makes it incredibly difficult as an elevator to manage business. I mean, if we don't know when we can move grain out, it makes it difficult to plan. It weighs on the market, it weighs on basis values. Freight markets remain expensive just to move it because nobody can get it. When the markets are tight, freight becomes more expensive. The assumption has been that the railroads will catch up at some point in time, and kind of optimistic about what new crop supplies of freight might look like, but it's looking less and less likely that we're going to catch up, and there's going to be freight issues at harvest time. So it's important to understand where your local elevators at and how they're going to handle grain, and how they're going to manage some of this, and mostly the price risk too. There will be price risk there on the basis side of it. Labor issues are weighing on efficiency of the railroads, risk of strikes, and just lack of labor. I don't think it's any secret. Everybody is struggling with labor. It's across every industry, and particularly agriculture. Labor is difficult to come by, and it's no different on the railroads. And it's weighing on performance. And with healthy supply and demand for new crop soybeans and other commodities as well, freight is going to need to perform at a high level to keep up. And right now we don't have any indicators that there's no confidence that that's going to be the case. So we look for freight rates to remain elevated and performance to be behind schedule. This is all going to be pretty negative on basis pricing. Again, it goes back to why we look at 30 under for a new crop delivered off the field, and these numbers are pretty strong for what we're facing on this end. Again, as we get into winter months, we're going to look at weather. It's always a wild card. Last year we had a very difficult winter, which makes execution performance on the railroad difficult just due to condition. Cold winter equals higher freight costs. It's kind of the long and short of it. So Frayne continued. This is just to go into look at labor and what's happening. This is public information that's kind of pulled here. In 2018, roughly 1 million cars were moved on BNSF. Same in 2021, but staff reduced by 20% roughly here. You can see in 2012, BNSF reported 41,000 employees, 2015, 44,000, 2018, 45,000, and in 2021, the most recent reporting, they had 35,000 employees. That's a significant reduction, and it's been tough to manage and see when they come. So with that too, secondary car values, they've been 100 to 200% higher this harvest from what we've seen and experienced in the market. And so this is going to continue to be a struggle, and it's going to be a challenge this harvest and going into the winter as well. So to back away from freight a little bit here, just put together just a quick break even. I know these are very subjective numbers. This is what we use for our local growers here. I don't want to get too far into the weeds on this, but your goal as an operator is to maximize profitability right now. And as you can see on the right hand side, I use a couple different averages here for yields, but looking at a 40 or 35 bushel yield average, I mean, wherever you may come out or see your crop, I believe that these are profitable levels where we're at here. This is using about $14.50 futures price and 30-cent basis for $14.20 cash. I think we're better than that now. And obviously subjective numbers here for your own farm too, but these are profitable levels. And so I think it's something that needs to be looked at and figuring out how you can, maximize the profitability on your farm. And locking in margins. We've had high inputs that we've been dealing with, from fertilizer, fuel, whatever else. At this point in time, if you can lock in margins, you need to do that. And not only for this year, but beyond as well. Input costs are high, but and we worry about getting crops and not being able to fulfill contracts. But there's methods to hedge your risk on some of these, and you can lock your margin in by buying your fertilizer and some of your inputs and selling your crop, and that puts you at risk for delivery on contracts. But there's ways to protect yourself, your options, whether it's buying inputs and selling futures. You can cover yourself buying a call or something of that nature, or just protecting your downside by buying a put and not engaging in any other margin locking or anything like that. So there's different options available that can help protect you from risk. And I know Bill talked about a little bit in hedging strategies that you use, but from a cash grain trading standpoint, there's ways to protect yourself financially on some of this as well. So additional note on profitability. These are just some charts we put together here. I took two different dates, and these are laid out for corn, just some nice charts we had here. This is gross revenue for 2023, so that'd be next year's corn crop, even with high inputs. So this is gross revenue less nutrient costs. So looking at what your fertilizer input's going to be, and you can see the last couple of years here how the rally in corn markets have really affected profitability, even with higher inputs. And so there's profitability on the farm right now. And at this point in time, managing risk is really important. And I think and staying engaged on it. So key takeaways. The crop potential is high with projected trendline yields. I think we can get there. Obviously, there's issues that can curtail our yields here, an early frost or hailstorm or something like that could really hurt us a little bit. Demand projected to remain strong with comfortably tight carryouts. Not a lot of room for error if we see some weather events or issues that shrink our crop a little bit. But at this point in time, it looks good. Geopolitical issues still front and center. They'll impact market. There's going to be more volatility. We're going to be dealing with this for a while. I think just walking through markets the last couple of days, you can kind of see that to the upside at least. But strong U.S. dollar could create headwinds for exporters, commodity pricing.
Rail performance will be a challenge with labor issues for upcoming season. Weather is always a wild card. Cash prices should be profitable on farm, and I anticipate that they'll remain strong for 22 and 23. So I've got my contact information here. If anybody has any questions on anything, feel free to email me or give me a call. More than happy to talk through anything. But otherwise, any questions that we have?
All right, I'm looking at the chat. David, I think that was really helpful. I think you brought up a couple good points about, drying costs and all of the local rail impacts and, really how these bigger issues are going to impact more locally our farmers. So I appreciate that.
Yeah.
I'm not seeing anything in the chat. So I think with that, you were perfectly on time. So we were going to take a 5-minute break and pick it up again at 11 with Mark to talk about the weather. David, if you still have time to hang on with us, if we get any questions at the end.
Yep.
Okay, great.
I'll be here hanging out.
Awesome. All right, well, we will break then and we'll pick up again at 11 o'clock. We'll have Mark get set up to give an overview on what we can expect from the weather. There it is. All right, it's 11 o'clock. So we are going to jump back in with Mark Ewens, meteorologist at KNOX out of Grand Forks. Mark's going to talk to us about what we can expect to see for the rest of the growing season and what harvest may bring us. So Mark, with that, we've got your slides ready to go. They look great, and I'll have you get started.
All right. Thank you very much, Jen. I appreciate it. And good morning, everyone. I've got a lot of slides that I'll go through. Fortunately, Frayne covered some of the information I'm going to talk about, which is okay. And then I want to do some international outlooks as well, since we're talking about other countries, obviously, with soybean potential. For those of you who might not know what this is, I am this old. Probably some of you do. This is a old Class A evaporation pan that the National Weather Service and a lot of different entities used to use to calculate evaporation on a daily basis. It suffered from something known as oasis effect. It overestimated the amount of evaporation, but it did its job, and it's something we maintained for many, many decades. It's now been replaced by more sophisticated equipment. So I am this old. Some facts and a few figures. Climate trends are a forecasting tool as well. These two images are for the North American region. These are changes on the left side, October to March from 97 to 97 to 2017, taking out the previous 30 years. And you can see there has been large areas of warming across the Northern Hemisphere. We know this for a fact just based on not at the data, but the observed changes within many of the different ecosystems. Precipitation wise, we'll get to that in a moment, but on the right-hand side is the April through September. So basically the cool season, and there's actually been less warming across portions of the region as well. So it's an interesting changes in the distribution, part of which are related to agriculture, part of them are related to things in the atmosphere we simply don't know. This is precipitation October through March, which is considered the cool season in the climate world. April to September, basically the warm season. And on the right-hand side, I will call your attention to the Northern Plains and to the Ohio Valley, where in the large scale over the long term, there has been significant increases in precipitation. We know that here in the Red River Valley, of course. I think it surprises some folks when we talk about the generalized increases in precipitation over Western North Dakota and Eastern Montana, but there's obviously much more variability. And since they have smaller amounts of precipitation than we do here in the East, they're far more sensitive to drought. Generally speaking, we've seen increases in precipitation. This is kind of a zoom in, October through March on the left, April through September on the right. And again, we see where there's broad areas of precipitation. This data is based on some high resolution data that includes cooperative network data. Many times you'll see data that is based on the gross scale first order weather stations. This includes the cooperative network, which has much more a higher dense network of data. So you'll see some subtleties that don't necessarily show up in the Class A data. October through March again for temperature on the left, April through September on the right. And I bring these up and rapidly go through them because we basically use these trends as an aid as to where we're headed. Now, this image is the aggregate annual Red River Basin precipitation for its period of record. And I'll show you what I mean by aggregate Red River Basin in a moment. And you can see there are obviously year to year, the thick green line is the year to year total precipitation. The blue line is the period of record average. Then there's a polynomial change, which just shows the gradual decrease through some of the drought years, several decades back, and then a gradual increase in precipitation as we've seen post the 1990s. And then a 15-year running mean, which in climatology we use to kind of describe the overall pattern in precipitation. Same scale or same type of scheme, excuse me, for temperature. We have seen generalized warming as one would expect, with some relative cool periods and relative warm periods intermixed. Now, what's interesting when you look at this graph, you'll see that basically over the last roughly 15 years, at least within the Red River Valley region, our temperature pattern is kind of flattened out, still a tremendous amount of variability. And when I say by division in Red River Basin, climate divisions very quickly, every state has 9 distinct climate divisions that within each division, for example, Northeast North Dakota, climate division 3, it's approximately homogeneous. So we can say the weather in Towner County is approximately the same as the weather in Grand Forks County. Or climate, I should say, excuse me, because we know the day-to-day weather varies considerably, but over a 30-year climate period, those zones, Northwest Minnesota Zone 1 is the northwestern quarter, the weather over a long period of time, the climate is approximately homogeneous. Now, just a quick recap from last October till a couple of days ago. This information is from the Regional Climate Center in Lincoln, Nebraska. And to the surprise of some folks, overall, our temperatures have been on the low side of normal. Obviously, recently, we've had some pretty warm weather, but in the long term, we've been on the low side of normal. Precipitation-wise, no surprise there. Excessive rains from eastern Montana across, especially the Red River Valley, and the large area of drought conditions in the Midwest. You can see the Oklahoma, Texas Panhandle in the far lower part of the screen. So you get an idea of the scale of the drought. And again, using the cooperative weather stations going back to the temperatures, you can see interspersed with the large areas of relatively warm weather, there are some areas where the temperature has been at or below normal. That is the reality of variable climate and weather. So something we deal with. I think we've probably all seen this by now as well. This was released just the other day, yesterday, I believe. This is the USDM most recent outlook, observed drought monitor, excuse me. So obviously serious drought, and this is a long-term picture. This is a long-term snapshot, and this product has evolved quite a bit over the years as well. It used to be far less granular. It had fewer inputs. And over the recent years, getting the state climatologists and down to the county managers involved in reporting, this product has become a little better. Maybe you don't agree, but I think for me, looking at it over the years, the drought monitor, its utility has gotten better because it's got more human input. Frayne kind of touched on this one as well. This is the Veggie Dry. This is from MODIS satellite, shows essentially the vegetation health, where it's too dry or too wet in the soils. And then another one, the Vegiscape from the USDA, the Vegetation Condition Explorer, based similar on a lot of the data from the Veggie Dry, the MODIS satellite information. So again, tools that Frayne already went over. Thanks for showing them, Frayne, because I think if you're not aware of these images and this data, this is something that's good when you're making assessments of the market. Another one, this is a relatively new research product that is being developed by the NOAA labs in Boulder, Colorado, the Evaporative Demand Drought Index. This is a sort of a longer term look of the demand of evaporation needed for crop use. And obviously it shows the very dry areas in the central and southern plains. On the right-hand side of the screen, this is a 3-month average, which still suggests that the northern half of North Dakota is still on the wet side. And I think that's borne out in a lot of the observations, and a 6-month average EDDI. So again, these are other tools that are basically using the Penman-Monteith reference evapotranspiration, something that I learned at NDSU about 3,000 years ago, and I'm glad to see that it's still in use with a 1/2 meter tall reference crop. So again, a lot of this is automated, but it does use real world data to go into it. So it is something that you may find interesting. This is at the NOAA website. You can search on this particular product and read up on it if you're interested. Just another tool in your toolkit when you're doing assessments of drought conditions. Now, there's also global drought analyses that have become quite viable and useful to a lot of the agricultural world. This is just the snapshot from the IRI, the Institute for Research on Climate out of Columbia University. I'll get a little more into these in detail later on, but this is a snapshot of the July 24th, 5th images of drought conditions across various parts, South America, African continent, Europe, Asia, and Australia, which many of you probably know. Australia was in a significant drought not too many years ago. Now they flipped because of changes in the Indian Ocean and ENSO signal, the El Nino La Nina signal, which has driven them to be quite wet. So they've had a 180-degree change in their climate over the last couple of years. We're looking at a classic ENSO just for reference in case you're not familiar. The left-hand screen is an El Nino where there's anomalous warming in the equatorial Pacific from the South American coast out to near the date line. The reverse is true for La Nina, anomalous cooling from the South American coast out to the date line approximately. But if you look at the two basins, the Pacific and the Atlantic basins, you see basically a mirror image that has occurred. Now, this was 1998, one of the strongest La Ninas on record compared to where we are now. There's been a virtual flip in the ocean sea surface temperature patterns. And I bring this up because this is also a very key tool that we use in forecasting the long-term climate and why we get into these relative repeatable patterns over a period of multiple years. Obviously, weather is what you get, climate is what you expect. That's one way to put it. A lot of folks probably have seen these graphics. These are somewhat archaic, and for many years, we used La Nina or El Nino as kind of the driving tool in doing climate forecasting. We've learned that there are far more subtle signals within the atmosphere, but this is still a viable generalized picture of what in the upper left, what La Nina, the impacts during the December through February timeframe and the June through August timeframe, what they approximate. So you get an idea globally of the impacts of La Nina during certain seasons of the year, kind of the core winter, December through February, and core summer, June through August. Right now, this is as of a couple of days ago. This is a satellite-based image from the NOAA Coral Reef Watch system. It's a 5-kilometer resolution sea surface temperature anomaly image. I'll call your attention to the very dark red blob in the north central Pacific. That is something called the core of the Pacific Decadal Oscillation. If you're not familiar with it, we can talk more about that later offline. But in combination with a positive PDO and the negative ENSO, the La Nina, this has set up a climate regime that looks to repeat itself as we get into this upcoming fall and winter. So the thumbnail is what we had last half of summer into fall and into next winter. These signals suggest they're going to repeat themselves. I like to throw this image up simply because it shows where we as meteorologists have gotten in the last 2 decades to have these satellite imagery available to us, where we can see on the left-hand side of the screen, there's the tropical system Usda in the northern Indian Ocean region in the western Pacific, and the plume of moisture flowing across just north of the equator to where there's, I forget Greg, and I forget the other name of the tropical system off Mexico. And then that arcs up into the monsoon, which is currently kicking off in the southwestern US. So we get to see these images that we used to not be able to see very well, or just kind of maybe once a day, and had to do a lot of estimating. Now we can see these images in motion and tie them to real-time climate signals. The big red blob in the center of the screen is an artifact of that very warm ocean water That's a recurring artifact of the Pacific Decadal Oscillation. So again, Frayne showed these as well, the 6 to 10 and 8 to 14 day outlooks, in part because of the repeating pattern, that very warm blob of atmospheric energy over the east central, north central Pacific will occasionally overlap into the northern US and create the upper level high that brings the warm temperatures to the mid Mississippi into the northern plains. Now, we haven't been consistently as hot as we could have been based on these outlooks, but it has happened. They also pick up on the monsoon moisture up through the Intermountain West and the relatively cooler temperatures to normal than what they would be because of, again, the ongoing monsoon. Frayne showed these as well. I don't remember if you had this one in the loop, Frayne. This is a week 3 to 4 outlook. It is a somewhat experimental at this time, and I don't think it's been released formally, but it is out there every day on the climate prediction website. I think this is only updated twice a week, and it's the same basic format. This goes through the 19th of August, showing a continuation of above normal temperatures over much of the same region with below normal precipitation. So there's your near-term outlook, really no basic change from where we've been. Now, the climate ensemble forecast system, which is the American extended numerical model that runs out to, well, several years actually, but operationally they use the data only about 6 months in advance. The top frames show the mean temperature departure from normal over the course of the next 2 weeks. The lower frame is then the weeks 3 and week 4. And if you look at that, you'll see the large area of maximum departures on the plus side over the upper Midwest. And then it oscillates in the 29th through in the latter periods. It seems to weaken somewhat and then come back in. So these are just examples of the forecast tools that are available to us to make outlooks of what is going to happen in the very near term. Again, this is the weeks 4 temperature and precipitation. I apologize. I overlapped them on myself. I was doing edits during the meeting while I was listening to y'all speak. So the upshot is warmer than normal temperatures and, drier weather across large parts of the region are expected to continue. So in climate, it's what you see is what you get. That's kind of the outlook looking forward. Analog outlooks. Now these are for on the far left, August to October, then the middle is October through December, and then December through March. These are precipitation outlooks based on the years of 84, 87, 89, 95, 96, 04, and 12. Those years represent where the ocean atmosphere signals as we have them now look most like then. And so by taking those assumptions and saying, okay, this is what the ocean atmosphere configuration looked like in those years, this was the weather that occurred over the climate that occurred over the next several months. So these are precipitation, and basically you do see continued below normal precipitation for the most part through large parts of the Central Plains into parts of the Great Lakes. There's the variability that shows up along southern Manitoba, southern Ontario, back into Saskatchewan of above normal precipitation that kind of eases on down into the northern plains as we get into the December to next March timeframe. So the far right image kind of suggests that the dry conditions will continue through the Midwest on into the winter season, with a very classic La Nina signal showing up in precipitation across the Pacific Northwest into the northern Great Lakes and parts of the Mississippi Valley as well. Okay, we talked about soil moisture. Soil moisture modeling and prediction is something that the Weather Service and other entities have been working on quite a bit. This is the lagged average soil moisture technique, where in part it's numerical models, the prediction of precipitation from the ensembles of the numerical models, and also what has happened in the past goes into this and how the soil moisture responds. The upshot is that going all the way into the end of November of this year, they expect essentially the same conditions that we're starting off with, where it's very dry, to stay very dry for the lack of precipitation and the essentially above normal temperatures. So again, climate is weather what you've got and what it's continued with. So until the ocean atmospheric systems kind of decouple and start to change, what we're seeing is unfortunately what's going to continue. So that's not necessarily good news, but take that into consideration. So the late summer into the fall outlooks feature normal temperatures and precipitation patterns biased towards the warm side of normal temperatures, with normal precipitation in our part of the world based on the current forecast sea surface temperatures, with a cool end. So a La Nina, the historical fall La Nina years for the Red River Valley for the Northern Plains region represent the current and recent climate trends with a bias to cooler and wetter as we get into the cool season. So it looks like a La Nina fall and winter. So the larger impacts may hold off into the heart of winter, kind of like last year. Many of the climate forecast models, both the US and the international, are predicting warmer and drier falls, transitioning to cold and wet for the 2023 season farther south. Maybe transitioning, that's going to be something that is kind of in question right now, but the models do suggest a relaxation in that general direction. Coming out of the 21 drought last fall, it was warm and dry, obviously fairly quickly to a wetter pattern across our parts of our region into the eastern US. And another important climate pattern is something known as the quasi-biennial oscillation. It's a very high level wind that flips every 2 years, and it has an impact on the weather in the equatorial region predominantly, that then drives how storm systems affect our region. So as we get deeper into the winter, the QBO may impact the effects of the La Nina, enhancing them. So we may have another winter in the Red River Valley region similar to last year. That's kind of the upshot. The National Multi-Member Ensemble Outlooks, this is for the month of August. Now, I use these because the ensemble technique is an approach to improve efficiency of individual models. And these are basically the best case scenarios. So it actually does show something of a relatively normal temperature pattern over North Dakota into southern Manitoba, with above normal temperatures, especially in the Intermountain West and through much of the Corn Belt region and into the southeastern US. Drier than normal across the Dakotas region. It has no signal of significance over much of the Corn Belt and parts of the Midwest into the Great Lakes. It does have some spotty wetness showing up in the southern plains. And with the increased model resolution, they're able to start see small things. There's a little green spot there in eastern Colorado, which suggests an increase in upslope showers and storms in the higher elevations. So the models have gotten better at even some smaller scale forecasting. August through September, the multi-members suggest continued warm, generally dry through the plains region, especially the northern and northern western US, the Great Lakes into Iowa and Missouri, across the Dakotas, with no real signal showing up. So basically what we've got is what's going to continue based on these models. But the below normal areas suggest that precipitation, at least in those areas on this process, the multi-member process, will remain cold. Below normal precipitation, excuse me. Same picture into the fall. It shows an expansion of the dryness. The previous slides, which showed the increase in the dry conditions through the southern and central plains, are based on the models as they get later into the fall season, showing continued below normal precipitation with above normal temperatures over the southern into the central plains. So again, the multi-member technique is something that has much better verification than one particular computer model. And as we get into the early winter, December through January, February, we see the colder air across Canada hinted as building into the northern plains, with an increase in precipitation finally over the northern Rockies, the southern Canadian provinces, into the Red River Valley region. So this suggests as we get into the DJF period, we're going to get cold and snowy again. That's kind of the outlook there. Again, some outlook guidance. Now, these are the previous years that I mentioned where the ocean atmosphere system was similar this year. And we take out the years prior to 1979 because there's a noted climate shift that occurred globally in 1979. That's another discussion. But we go back and look at those years and we see that temperature wise, for the August, or excuse me, the October through March time period, generally below normal temperatures with above normal precipitation over the Red River Valley. And again, when I showed that earlier graph that showed how precipitation has gone up, basically post 1990s, the wet cycle we've started then, we're still in. Now, this is just the raw outlook based on the composite years post 77, and it shows a broad area of cold with essentially not as strong a precipitation signal in our area, drier to the south. So the drier weather, this is a non-trends adjusted. So the trends adjusted suggest perhaps a little wetter, not as cold. The raw analogs show it a little colder and over a larger area and perhaps drier. So again, that's kind of the screaming message. What we had is what we'll get. So now I'm going to go through some of these because I see my time, is getting a little short, but this is from the International Research Institute for Climate and Society. The IRI was based at Columbia University as a cooperative amongst many different entities across the meteorological and climatological realm. The National Multi-Member Ensemble System that I was just referencing is the operational NOAA version, and it's a cooperative agreement amongst many partners, including the IRI. So there is an international effort to try to improve weather forecasting. Who'd have thought? Okay, South America, August to October, September to November, October to December, so labeled. The top row are the temperature outlooks. You can see where they're expecting very warm conditions across large parts. Like I see, and I have to check my notes to make sure I do this right. Like Argentina, generally above normal temperatures to the end of the winter into the spring and early summer there. Southern hemisphere, dry most areas except in the northwest along the Argentinian-Chile border, where there'll be above normal precipitation. Obviously, some above normal precipitation across Brazil, where temperatures are forecast to be a little on the cooler side of normal there. So again, these are based on the multi-member ensembles from the IRI. These have fairly good skill, especially over the South American region. Australia, basically the upshot is they're looking for a cold and wet winter across the Australian region. So what impacts that has on those of you planning travel to Australia, and it's all relative, of course, but they've been subject to some pretty significant flooding in Australia the last several years, certain parts of Australia. So they're looking at a fairly cold late winter into early spring season for them down there. Asia, late summer into early fall and winter. Again, looking at August to October through November of 22 to January of 23. And these are 3-month averages. Obviously, Ukraine, was asked about that, but excessive heat with generally warmer period, wet precipitation expected, wet regions in the northern Black Sea region, transitioning to early winter, otherwise no strong precipitation signal across there. I'll get to that in a moment as well. But it looks like, generally speaking, large sections of China above normal temperatures as we get into the fall and winter, trending a little closer to normal, and they're expected to have spotty precipitation areas that are orographically driven. Again, I mentioned how the models are much better at actually depicting orographically driven precipitation. So those kind of east-west oriented above normal precipitation segments in China relate to upslope precipitation with a general drying along the coastal regions. And India, well, the monsoon there, I mean, even though that's a different story, they're gradually expected to continue to stay wet and gradually decrease in precipitation. Yeah, so generally a mixed bag, as you can see across the region, with large swaths of above normal temperatures, except Thailand and Cambodia, Vietnam. They're looking to transition into a cooler side of normal, getting into the late fall, early winter. Europe, I broke these into 2 different sections. These are the temperature outlooks. Ukraine, again, looking very warm, but across large portions of Europe, expecting above normal temperatures well into the northern hemisphere, late fall and early winter seasons. And precipitation wise, again, a lot of orographically driven precipitation areas where the green is showing up, transitioning to more normal or below normal precipitation across portions of Europe. The Middle East, same basic story. Above normal temperatures are expected as we get across much of the areas we get into the late fall, early winter season, and precipitation outlooks. And again, I apologize for going through these so quickly. They're available online and we can discuss them in detail later as well. But basically, north of the equator, equatorial regions, generally drier than normal. So kind of the hot and dusties. Africa, the outlook along the equatorial regions, temperature-wise, a little cooler than normal, transitioning to an above normal temperature pattern, getting into the November to January 23 time period, a little cooler in far South Africa. Again, above normal precipitation generally along the equatorial regions, which is expected this time of year, and then transitioning. The white area suggests that the models really don't have a forecast, that basically there's too many conflicting signals within the systems to give an accurate forecast. Otherwise, the browns are below normal precipitation, the greens above normal. So again, apologies for running through them so quick, but that was basically it. The status quo is really kind of the end of the day, the main message of what we're looking at, because of not just the northern Atlantic, northern Pacific, but the southern Pacific and southern Atlantic. There are climate modes within that atmospheric ocean signal that have remained stable. So we're basically in a period of relatively stable globally climate weather interface. So I hope that made sense. I know I zipped through a lot of stuff very quickly, but questions, comments? I got a couple of minutes, I believe.
Yeah, absolutely. And we'll take questions for any of the speakers at this time too. I think your prediction of a warm, dry fall, we don't want an early frost or an early blizzard this year. So that sits well, Mark.
Yeah, and interestingly, I was actually talking with a friend of mine who's a farmer over in the Middle River, Minnesota area, and we discussed how a lot of times in these warm falls there'll be that one anomalous early frost that seems to just screw everything up, and then it goes back to being above normal. So
Okay.
that's kind of an odd climatological quirk within the system that nobody's really figured out why that is.
Well, that's a fair warning. We do have a question for you, Mark, in the chat. What about the weather forecast for North Dakota, South Dakota, and Minnesota in the first few weeks of August, so prior to harvest?
Yep. Basically, there is no strong positive precipitation signal of significance showing up. I mean, we've kind of been oscillating a little bit around this wet cycle, dry cycle. I think right now, from what I'm looking at, that there is a secondary climatological peak of convection in the time period that we're running into. We have the big peak in late May into June. There's a secondary peak in August. Right now, what I'm seeing, above normal temperatures, kind of the main image, with below normal precipitation. That's my guess right now. And yes, I said guess.
Any other questions? I'm watching the chat. One other question I had for the group, Ukraine, Russia was brought up a few times today, and Frayne, you alluded to when this started, we thought it would not last nearly as long as it had. I remember I joined the USDA Ag Outlook Forum the morning that Russia had invaded Ukraine, and the Secretary of Ag started that meeting by saying, we've put a lot of work into these numbers and we're not sure any of them are right anymore. So I guess thoughts on how this longer sustained conflict may impact all of the plans we've heard over the last 2 years for increased crush. Obviously, we see a lot of sunflower oil taken out of the market. Does that mean, we're hearing a lot that there's lots of plans announced for crush in the US, but don't expect them all to happen. How do you think Ukraine, Russia plays into that?
I'll take a shot at it first, and then I'll let others follow up. So first, obviously, building a crush plant, you're looking at several $100 million worth of investment. You have to be very careful about making that investment. A lot of companies really would prefer to expand existing crush capacity rather than look at adding a whole new facility. Most companies are very hesitant to put money into what they call a greenfields or a brand new project. But we are hearing quite a bit of that, not only in the U.S. for soybean crush, but also in Canada for canola crush. I do think the the fact that not only domestic but also global oilseed prices have rallied has obviously enhanced that interest. We can't blame or put all of that on the weight of or on the back of what happened in Russia, Ukraine. Sunflower oil, when we think about oil in the global oilseed market, sunflower oil is actually relatively small volume wise relative to the largest, which is palm oil, and followed closely by internationally by soybean oil. So there's obviously a connection between what's happening domestically and internationally. So there gets to be, once again, a lot of moving parts. So Jenna, I guess to answer the question directly, I do think it's playing into the psychology or the kind of in the back of people's minds that, yeah, if Russia and Ukraine, who are again big sunflower producers, primarily Russia, producer and exporter of oils, of the crushed oil, if they continue to have problems, if there continues to be disruptions in their supply chains, that does open up the door for some alternative oil seeds to come in. The two largest, as I'll point to, is first palm oil and then soybean oil. I guess the answer is I agree. I think there's a lot of projects on deck. There's a lot of projects that have been announced. But when you look at putting that kind of investment in and thinking about not only oil distribution, but also the meal distribution and where's the meal products going to go, it gets complicated. So to try and answer it, I'm stumbling here, but I'm trying to collect my thoughts as well. But so the Russia-Ukraine war issue, I think is adding some complexity to overall demand, supply demand globally for oil seeds. A lot of what we've seen over the last several months has really been the palm oil issues, and some problems in Indonesia, in particularly in supplying global oil seeds. So I think that's probably playing a larger role than it would be out of Ukraine, Russia, but it's something that the markets are obviously looking at. So, and that would have an impact again, not only on the canola crush in Canada and their crush capacity that's coming online, but also some of the crush plants, I think, here in the US.
Sure. Along those lines, Bill, we have a question for you to give us thoughts on the Russia-Ukraine situation. I don't know that you had those in your presentation. Any thoughts you would like to contribute?
Regarding the oilseed question?
It just says about the Russia-Ukraine situation.
So I'd respond the following. Just on these oilseed plants within North America, many of those were announced before we had a rapid escalation in prices, inflationary prices. And already one or two have been mothballed. And I'm sure that is because their projected cost of development is far less than what it is reality right now. So there are probably fewer plants developed than earlier thought in this country. Regarding Russia and Ukraine, so these are pretty radical changes. We are going from, in 2021, a cereals crop of 100 million tons to this year 70, to next year probably 50. Probably that will be shifting out of corn, maybe completely, and primarily to wheat and barley because it's lower input costs and easier to store. And secondly, at the moment, looking at 23, the only profitable crops that exist in Ukraine are oil seeds, and sunflowers are very profitable there. They're also easier to ship. And as I monitor the exports, seems though they have a lot of trouble getting exports of wheat out in corn, but they seem to not have any trouble exporting sunflower oil. So I would expect there will be a radical reduction in plantings next year and a shift to the oil seeds in general, which in Ukraine is predominantly sunflowers. So that's it. From how long is this going to last? Nobody knows. My state of knowledge would be it'll last as long as the US funds the Ukrainian war. And at a time when the politics get impatient with doing that, they're going to have to tell Zelensky he's going to have to cave in on his negotiations and give up on the land in the eastern provinces. That'll be a shocker for everybody involved. But the Russians' plan is this is going to be 4 to 5 years in duration. It's a matter of, in my view, how long we fund the war. How's that?
Good. I mean, not good, but it is what it is.
What's good for American agriculture?
Yeah.
Yep.
Yeah, it's hard to keep up some days. As David said, we got notification that they signed an agreement to move grain, and then 2 days later, we got notification that the terminals were bombed.
So on that topic, our view, and I'm pretty intensely involved, we think that's a bunch of crap, actually. I don't understand why Russia would want to open up the seaway that would give Ukraine $1 billion a month to fight a war that they currently don't have. I don't understand. I don't understand that.
Sure.
Secondly, Russia is the major competitor in Black Sea grains, and Russia's got an export tax of $88 a ton. And if they open up the Black Sea, that means Ukraine can undercut them by $88 a ton. I don't understand why that's good for Russia. So my personal view is, I think Russia's blowing smoke. And that seems to be the case in the past 7 days. How's that?
Any other thoughts? I know we're going.
Talk about in Argyle.
A lot of discussion about Ukraine blowing smoke,
Yeah.
No, Russia blowing smoke.
or Russia blowing smoke.
Yeah. I know we're 10 minutes over on time. Any other questions, thoughts before we close here? Again, we are recording this. You'll get it in your, we'll put it on our website. I'll send you a link next week once we get all that done. So,
Thank you. Good seeing you, David.
Yeah, you too, Bill.
Yeah, bye.
And Frayne.
all right. Thanks all. Have a good day.